May I request some of you to please come forward? You can. And welcome to the second day of the Business Standard BFSI Insight Summit. Yesterday was a packed day, but it was largely about banking. We had the Secretary, Department of Financial Services, Mr. Nagaraju, speaking about, cautioning against complacency, against cyber threat. Then we had Dr. Nageshwaran, Chief Economic Advisor, speaking about digital arrest and the need to take measures to prevent this. He also spoke about the need for India to build strategic invulnerability as a roadmap for strategic indispensability in an increasingly changing, inward-looking, protectionist world. We also had Deputy RBI Governor Dr. Poonam Gupta speaking about building supply chain resilience. Today is another packed day. We will have retired chairperson, Mr. Ajay Seth. We will have Ms. Arundhati Bhattacharya, chairperson and CEO, Salesforce India, and Mr. T. Ravi Shankar, Deputy Governor, Reserve Bank of India. We will also have Mr. S. Raman, chairperson, PFRDA. But our first session today in this hall, the Narayan Vagul Hall, is about cryptocurrency. Yes, our panelists are just walking in. The conversation is about India's crypto crossroads. Is it time for a policy rethink? Now, India finds itself as a crossroads in its approach to cryptocurrencies. On one hand, adoption among retail investors and developers continues apace, while on the other hand, regulators, particularly the RBI, remain deeply concerned about financial stability, macro monetary control, and worries about illicit flows. Also, the current tax regime, which has imposed a flat high rate on gains from virtual digital assets, it signals a deterrent posture rather than facilitation of innovation. Against this backdrop, the question arises whether India should move from deterrence and uncertainty towards a coherent framework that balances innovation, investor protection, and oversight. Steering this conversation will be Business Standard Technology Editor, Ms. Shivani Shinde. May I request her to please come on stage? May I also invite our panelists. We have with us Mr. Dilip Janoy, Chairperson, Bharat Web3 Association, which is the apex body for leading Web3 technology companies in India. May I please invite him on stage? A huge round of applause, ladies and gentlemen. We have Mr. Sumit Gupta, founder and CEO, CoinDCX. Mr. Gupta founded the company in 2018. Do please come on stage. Mr. Gupta founded the company in 2018, and today it has over 20 million users. We also have with us Mr. G. Padmanabhan, former Executive Director, Reserve Bank of India. He has over 3 decades of experience across areas such as banking regulation, foreign exchange, and security supervision, information technology, and payment systems, among others. And our fourth panelist is Mr. S.P. Sekar, Head of Asia Pacific, Binance. He has over 20 years of experience across the public sector, fintech, and blockchain, with deep expertise in legal, compliance, and market access matters, among other areas. Over to you, Shivani.
Good morning. As a moderator, I think there are 2 most difficult sessions to conduct. One is the early morning first, and the other one is after lunch. So I hope everybody has had a good warm cup of coffee, tea, or juice. So I think it's the most happening topic that we are discussing, and good we are doing this first thing in the morning. India's crypto story has been one of extremes, from investor enthusiasm to regulatory caution. The world is, of course, moving towards more structured frameworks. You have EU's MiCA, the G20 consensus taking shape. Of course, we do have FIU in India as well. But I think what we're going to discuss is it India's time to take a stand? And is the time now? So this is a question to all the panelists. Is it time for India to take a unanimous stand on crypto? The reason I ask is, as we are aware, RBI is steadfast on its stand, but recently the finance minister said that we need to prepare and engage with crypto assets, right? Like such a stable coin. So Dilip, let's start with you. What's your view? And we can go.
Yeah, so thank you, Shivani, and good morning to all of you. Early morning session for some of you is easy, but some of us have got at 4 a.m. to be here. Yes. But starting 4 minutes late for the first session of the day is actually pretty good. But I think we tend to, whenever we talk of regulation in the virtual digital asset, we always look at the investor side of things and the investment side of things, right? And by overly focusing on that, we forget the development aspect of and the other aspects of the technology, which enables different kinds of products and services to be delivered to people at low cost instantly in different corners of the country. Now, by delaying regulation or by delaying supporting this sector, not only are you actually putting Indian companies or companies built by young Indians like, let's say, Sumit here, at a disadvantage, and you are encouraging them to look at avenues outside of India. Recently, there was a study done by Primus Partners which showed that 27% of the biggest kind of investors and creators of products here, right, have actually moved out of India and moved overseas. And they are not, one example is Drive. Drive is an interesting competitor to Uber and Ola and all of that in Bangalore. They've closed shop, they started in Bangalore and Dubai, they've closed shop in Bangalore, and they're doing that in Dubai. So it's a big challenge there. And India has a $1.1 trillion opportunity by 2032 in this space. We are actually, every time and every month we delay, right, is there. And given that India took the leadership in G20 to get a global regulation, we've got a kind of a blueprint out there. G20 and 18 of the nations, but G20 is bigger than 20, 18 of those nations have some sort of regulation there. India does not. So I think it's time that all of us got together and created a regulation going forward. And it's not very difficult to do. There's so many examples there. You can pick and choose. You can do whatever you want to do. But I think we need to have clarity on this sector. You can say, okay, like fintech, please do your own regulation, have a self-regulatory authority. Great, but we need regulation here.
Yeah, I think, first of all, thanks for having me here. The answer to the question that you asked is astounding yes. I think it's high time that we look at regulations. Everyone knows that. Some people say it, some don't, but the answer is yes. And the best time to regulate the sector was yesterday. The next best is today. If we don't do it today, then we'll lose out. It's a big, big risk that's sitting in front of us if we don't innovate in the sector. Look, I am in this space from last 10 years, 8 years, almost 8 years since building CoinDCX. Every single day, week has been a nightmare to run an exchange in India because of the uncertainty, and every business wants certainty. 90% of my friends have moved out of the country. These are talented, bright IIT engineers, grads who have been building companies in internet space, have now moved out. And it's going to be very, very difficult for us to bring the talent back if we are too late in the game. So I think it's high time. It's a very appropriate time to discuss that. The world is moving fast. If we don't, we will be excluded out of this redefining of financial landscape that's happening across the world.
Right. Mr. Padmanabhan.
Well, first of all, thank you very much for inviting me. When I got this invite, and looked at my fellow panelists, I was asking myself the question, am I a pigeon among the cats or am I the cat among the pigeons? But having said that, I think clearly the answer to the question that you have raised is yes, we need to have this regulation. Now, let me try to articulate it by saying few things. One is that, what is the future of finance? Now, clearly the answer is the future of finance is digital. The future of finance is tokenization. So if this has to be accepted, the second aspect we look at it is, when we are looking at regulation, at least time has come, and I made this point, that we need to, at least the regulators have missed the bus as far as the crypto is concerned. Crypto has come, crypto is difficult, crypto is more difficult in this country, or even stable coin, because over and above the other kind of concerns that a regulator have. Incidentally, one of the qualities that people look for a regulator when they are selected is, do they know how to worry? They worry when nothing happens, they worry when too much happens. But in this case, the exchange control or the FEMA aspects adds complications to this entire aspect. When we are talking about, I think Dilip was saying when we were discussing there, in a matter of seconds, in a matter of few cents, the money can go across, and it's seamless, right? So these complications do arise, but having said that, I also want to flag the fact that among the IMF countries, members, 70% of the countries are already looking at some kind of a regulation as far as the stable coin is concerned, because they feel that stable coin growth is going to be much more, probably faster than the crypto, maybe 300 billion today, but it's going to grow very fast. There needs to be some kind of a structured regulation to make sure that the world works together for the betterment in terms of, particularly in both all these cases, I see the most important use case for cross-border transactions.
Hi, everyone. So I'll answer the question in two parts, right? The first part is, regulations are there to protect national interests and to protect consumers, generally speaking. On the consumer protection front, the ship has sailed to some extent. Let's look at the statistics when it comes to persons of Indian origin holding digital assets, right? At the moment, we're talking about 5 billion AUM of assets in terms of household holdings of digital assets. We're talking about a country which for the last 4 years has been the standout leader in terms of digital asset adoption in a region, APAC, which already sees 69 to 70% growth year on year, right? So you are the front runner in digital asset adoption. And we have to recognize that. So now that we recognize that, and that is the trend in a very young, internet mobile, savvy, and a population that's focused on asset accumulation, what does that mean for regulation, right? And I take the points that the panelists have made that there are national interests to consider, and regulations should wrap around that. Among the G20 countries who made a commitment in 2023, I think India is probably the only one yet that operates on an AML registration model, hasn't gone to a full licensing model. The good thing is you have loads of countries ahead of you who tried this, architected this, failed, and then learned from it. So an activity-based licensing, and you can take an exchange apart in 6 components, right? There is the order book, there is the matching engine, there is clearing and settlement, there is custody, right? These are the core components of any exchange, and then you add all the hundreds of bits on top of that. Each of these activities can be sensibly regulated and have been sensibly regulated in many parts of the world. Now, India is not alone again in terms of countries which have a concern with capital flight and currency control. Again, I think having a stablecoin project, and it doesn't matter if it's CBDCs, if it's private stablecoins, if it's rupee-backed tokens, the mechanism doesn't actually matter. In terms of the objective we're trying to hit, which is to manage the use of tokens that have an impact on the rupee, there have been blueprints out there that have worked for other countries. Again, India can adapt that, and India will always choose its own path. But there are templates out there that have worked, and I think moving in that direction makes most sense given the rate of adoption that exists in this country today.
Thanks for the detailed answer, Shekhar. Rather, that's gets into my second question as well, since you've talked about the 6 components that you required. Starting off with you, Shekhar, and probably, sir, you can jump into that. Do we need a separate regulatory body when we are talking about this ecosystem?
I think that's a question for existing regulatory frameworks to consider. I wouldn't want to delve into that too much because it's a bit of a black box, right? But what I would say is there are two models in this world. There is the Dubai model where VARA was specifically created to deal with this. There are many other countries which have folded it within the securities and central banking frameworks. The outcome is the only thing that matters, right? As long as they have the constitutional mandate, I don't see why it has to be a separate body. But again, to Sunit's point, right, this is an opportunity which is cresting in India. 11 to 12% of all global developers on blockchain projects are of Indian origin. And a vast majority of them are not in India anymore. And so that's a point of concern. That's my view on that.
Right. So what do you think, Padmanabhan sir? Do you think we need a separate regulatory body?
See, look, this question keeps getting asked whenever we see something where resolution is not happening quickly. But I'm not very certain that having a separate regulatory body is going to solve for everything. I think what we need is the people with the right attitude should be able to say that now my idea is to, if innovation has to happen, I need to allow innovation to go through till I see an issue at a macro level, then I step in. And that's how, in fact, if you ask me the question on a different context, how microfinance grew up in this country, I think it is because of the light touch regulation to start with. So if we start thinking about the most difficult part of the regulation, now let me also make a statement here that unless we are able to get the other countries and have come out with some common standards, one of the important aspects necessary for any kind of a tokenized version to function as a money medium of exchange will be lost, because the singleness of money, which is important, will be lost. You cannot have 20 stable coins in your pocket and keep paying for anything. So it is important that regulators will have to think through whether a separate set of regulators will come out with better outcomes. I do not know. But having said that, please remember that Reserve Bank itself in a way accepted this because they recently formed a separate department called the FinTech department to deal with these aspects. So these are moving things, but outcomes cannot be based on, a separate setup.
So just a comment, and probably Sumit, you would want to agree or disagree with it. What you just stated, sir, FinTech has brunt or bear the brunt of the not having RBI look at them directly, but then when they are right there trying to do something, some policy comes up, and I mean, this is my opinion, but of course...
I can answer that. The point here is in a technology-driven scenario, I think one of the important attributes that a regulator must have is the agility. Now, you cannot expect things to happen, continue for some time, pretending that nothing is happening, then come and stop everything. So in a very lighter vein, I would say that probably in this country, FinTech is over-regulated and stable coins are under-regulated.
That's an interesting one. But coming to Sekhar, to you, and Sumit, to you as well, more specific questions to you. Binance registered with FIU last year. It's almost a year now. How big or how significant is India going to be for you guys?
Look, I think across digital asset world is going to be a big year. Again, I think statistics help. So FIU registration is at this point the only regulatory touch point, right, for crypto exchanges like us. Of course, the PMLA allows for the FIU to then use that corporation to support other agencies on the back end, and that's totally fine, and that makes total sense. In the last couple of years, and we are familiar with this, in the last couple of years, we've responded to close to 225,000 law enforcement requests globally, and we do this at scale globally. We've trained or collaborated or worked with 400 plus law enforcement agencies around the world in the last 2 years. And so our cooperation with FIU, whether it's via FinNet or via SIOG with other law enforcement agencies, is something that we do across the world. We think this works for now from a perspective that we want to control some of the risks with digital assets. And these are tail-end risks usually in nefarious sectors, which we need to weed out of the system. We're also fully KYC'd across the world, including in India. And that's one of the plus points of a centralized exchange, right, of CoinDACX of us. And one of the things we are always concerned about is an existential crisis commercially, but also from a law enforcement perspective, is a leakage of users to unregulated, unlicensed, decentralized platforms, which are just ghost protocols, right? And there's no way of touching them or dealing with them. And so while we are content with this outcome for now, what we really hope for is a full scope licensing framework, because that provides business certainty. Right? And Sunit mentioned this. It's a struggle for everybody. I think there would be a lot more direct investment in India and sort of job creations and placements here if there was a clear path forward. What activities are we allowed to do? What are we not allowed to do? What activities are controlled in what manner? What are the risks that the regulatory bodies want to cover for? Because there are reams and reams of technology tools that we can bring to bear to control for risks, right? For example, facial ID recognition, post-deposit, pre-trading, right? To deal with device ID change issues and mule account issues. And, for example, we have self-trading, mandatory self-trading prevention mechanisms. We have mechanisms that kick in when your futures or derivatives trading incurs a certain amount of loss to stop you as a cooling off measure, which is not available in TradFi brokerages, right? These technology tools allow operators like us and CoinDCX to do things at scale, but in a risk-controlled manner. So we're looking forward to that sort of sensible regulation that gives us the roadmap to work with regulators to basically blueprint what India could be in 5-10 years. And at its current course, digital asset adoption is scheduled to hit 30 billion in 5 to 7 years' time. That number could steeply accelerate if we had a framework that allowed people to participate with a bit more confidence in what's going to happen.
Interesting. Sumit, you said you've been building the crypto exchange almost a decade. And I'm giving my feedback. As a journalist, I rooted for crypto because I thought it was the most secure platform in terms of security. The last 2-3 years, probably I can't say the same thing. The kind of hacks we have seen, the kind of responsibilities exchanges have taken has kind of been weird, if I have to use. So one was trying to convince the regulator that, guys, we need to be regulated, but this is happening simultaneously. And if you are losing retail investors' confidence, that becomes a question mark. How do you see one of these, and how are you making sure that retail investor continues for crypto?
Yeah, I think that's also an important one. And what I'd like to say is that over the last 3 years, if you see, there have been numerous such incidents that have happened, not just in India, but globally. What really matters is how you deal with them and whether investors are protected at all times or not. In the absence of regulations, that is the risk that is imposed on the investors. That's not good for the country as well. And in the absence of any clarity, there are loopholes that exist, and then people can use that, which is not good. But when you have regulations, you make sure that you are allowing the right credible players to operate in the sector. At no point customers are getting impacted, and your domestic industry, is run in a way where if there is any issue that happens, that gets resolved for the customers in a prompt manner. This is what's most important. And customers at all times should always be protected. That's what, it's a solved problem. A lot of solutions exist there. So I think that is one approach to solve it. And in terms of the point that Sir has mentioned, I think the way the industry is moving, the pace at which things are moving, right? It's very important that we will not be able to sort of have a rigid framework which will solve for the next 5 years. It will continue to evolve, and the approach there should be light touch regulations that solves for investors at the center of it, gives visibility, supervision to the regulator so that they are comfortable if something is going too fast or too slow, and also make sure that your businesses in the country are sort of running in a nice manner, following all the guidelines, no bad actors are using the system. So all of that actually will be a subset of the overall framework that will come.
Right. The next most talked about, of course, topic has been stablecoin, and we must thank President Trump for it. He has made it a buzzword. But having said that, yes, this is CBDC versus stablecoin. And I'm asking this question to all the four of you here. India is yet to take a stand on it. Should India recognize an INR-backed stablecoin, or we head again towards a US-backed stablecoin, or again are we going to lose this battle as well? Dilip, would you want to start?
I think one of the challenges that the RBI is facing in terms of the whole regulation in this space is the dollarization of the economy. Now, if you want to address the dollarization of the economy, what did BRICS do? BRICS actually created a trade settlement mechanism based on virtual digital assets, which is non-dollar linked, right? And unfortunately, India did not participate in that. So if we talk about how to address it and what to do, there are solutions, right? And again, the challenge here is that one view could be the whole world is doing it. The whole world did something in 2008. India did not do it. India came out of it in a very different manner than the others did. Similarly, during COVID, a lot of people did, X percentage of GDP and pumped it in. India did a different thing. But I think this time, possibly the tea leaves are reading slightly different. So we should look at, and since we're the largest remitters in the world, right? And using an INR stable coin will reduce the amount of charges that it is remitted to India. We'll get more money into the hands of Indians. So I think we should look at it seriously. We found the UPI moment. Is this the new UPI moment in international, remittances? That's one thing. Trade settlement. A whole lot of use cases could be done. But again, like Mr. Padmanabhan said, we need a global consensus going in here. But I believe we should seriously look at Indian INR stable coin. CBDC and the stable coin don't compete with each other. They have different use cases. And in fact, very simple. You want to increase CBDC usage in consumers? Say you can only use CBDC to buy any virtual digital asset because they have the wallets, they have everything. It immediately solves a whole set of problems for everyone.
Mr. Padmanabhan, CBDC frankly hasn't gone anywhere. So again, the same question, but this in context.
Yeah, I think your question whether we should think about stablecoin, rupee, dollar, I think today, as we speak, 97%, if my statistics is right, what I read, stable coins are all US linked. If we are going to continue that to happen, two outcomes. It is going to be a US dollar economy. The US dollar is going to be more important. Then what happens to your monetary policy? The biggest thing that the central banker would think is that, is US going to decide about my monetary policy? How does it work? So then if we are talking about an alternate to US dollar, physical currency I'm talking about, then I think this question answer is very clear. You simply cannot allow US dollar stable coins and then keep quiet that they will take care of everything. You will have to think about what policy responses that you need to take. This is very critical. Now, if I can take a sentence to the issue that Sumit talked about, I think the regulation has to today move towards, as far as these aspects are concerned, more and more principle-based. Where you say that the regulator will at upfront say that these are 5 things which has to be adhered to as far as this country is concerned, and 5 things which are not acceptable to me. It may be acceptable to US, is not acceptable to me. Once that certainty is there, then the market moves better.
Yeah, you can go ahead. So, Sumit,
I think it's great hearing that from sir, right? In terms of principle-based regulation, I think that is the right approach. And as things evolve, we can continue to evolve those regulations. In terms of stablecoin, just one point I would like to add, and all the data points states that $300 billion in circulation right now, probably going to touch $2 trillion in the next, by 2030 or so. Multiple reports, so that's undoubted. And US is moving really, really fast. And if we don't act, what they are doing is they are internationalizing dollars. What India cannot sit idle. India need to internationalize rupee so that our economy becomes stronger. If we don't act on it, that's going to be very slow, and we will lose that as well because, like sir mentioned, 97% and even more of that is, US dollar-backed stable coins. Many other countries are now launching their regional stable coins. India does not have anything. CBDC is the only effort right now. I have different point of view there. I mean, CBDC is good. But see, that's for a different use case. If we want to internationalize rupee on retail, for example, cross-border, I think it was already mentioned. For cross-border, CBDC, great, fantastic, you can apply and so. But if we want to internationalize rupee, then there is a need for government to also allow INR-backed stablecoins, something that we believe is going to strengthen things a lot more, because when this $1.7 trillion will get added, where is India sitting in that? And that's something that we should think seriously about.
Right. Sikar, would you want to add?
Sure. I think it's closer to 99% USD stablecoin dominance Mica and euro-denominated stablecoins have barely made a dent, and for good reason. Nobody is interested in using it for international settlements. The reason why the US dollar is dominant in international trade and international finance is because it is the choice instrument for settlement, right? And because it's backstopped, and we all believe that it'll be backstopped. Now, India, I think, is on the cusp of a model where, thanks to the Trump administration and Chairman Paul Atkins, they have accelerated the move to entrench USD because it's programmable and it's interoperable, right? And it's now circulating at a higher velocity. And GDP is a function of money supply times velocity, right? And so the velocity of USD is going to increase, and it's already increased. And now it is possible for a person in India to deal with a merchant in India, potentially, right? And use a digital version of USD. And that is not some, well, you can put the brakes on that, but that's going to happen at velocity around the world. Now, therefore, countries around the world are waking up to this and going, well, we have national interests here, and we also have to make our currency interoperable and digitally available so that it remains at least at parity with our current, with their current standing, right? And so the rupee has an opportunity, and this is purely a construct and a decision for RBI. How you build it is totally up to India, right? But building something that works, that's interoperable and programmable will at least maintain India's position in the backing order, in my personal view. Just coming to CBDCs versus stablecoins, right? I think any country has to make a clear-headed choice. CBDCs also lend to bank intermediation, because what happens is when CBDCs are launched, depending whether it's wholesale CBDC or retail CBDC, it's going to pool liquidity from commercial banks. It has to offer some interest rate, right? Some returns to be attractive. Otherwise, there's no adoption. The moment CBDCs offer interest rates and yield, some of the deposits that go into commercial banks are going to go into CBDCs. So what does that do to commercial banks? It affects their credit cycles. It affects their balance sheet. It affects fractional banking. Now, these are structural problems that CBDCs face, and different countries have tried to solve it in different ways. And I think we just have to be clear-headed about what the trade-offs are. Now, if you do a rupee-backed stablecoin issuance, and there again you have a fork in the road. Are you going to go the US route, which is public-private partnership, and have a whole bunch of private companies issuing effectively USD-backed stablecoins? The control mechanism there usually is one-to-one reserve management, right? So with CBDCs, it's backstopped by the government guarantee. With private stablecoins, one-to-one reserve management. Or you can do a government-issued stablecoin, which I think makes the most sense to me. So I think these are options. They're all relative. They're always trade-offs. India just has to choose a set of trade-offs that it is comfortable with.
If I can just add one thought, which I just... we will have to admit the fact that CBDC is also a stable coin. It's a government-issued stable coin, basically. Now, one question for policymakers thinking through is that whether we should talk about some kind of... He talked about the public-private partnership. There is any possibility of linkage between a private stable coin, which ultimately coming and resting in a CBDC, so that, I mean, the singleness issue and all those points are taken care of. So, lot of thoughts need to get into this to see how we position ourselves, but it's very important.
I have just been told that I need to get into the Q&A segment. We already have a hand, but I have a question, and sir, I'll come to you. This is more for both Dilip and Sumit. You know, and you mentioned that as well, the whole founder ecosystem moving away from India, that's bigger concern. And crypto and stablecoin is just not about one technology. There's a huge base here. You have blockchain, you have Web3. But how is that panning out, sir? I mean, Dilip, I have to ask you this. Has it impacted that segment as well? The innovation going away from here?
Yeah, that's the figure that I quoted, you know, in the wake-up call, that 26% of people after Sumit actually also mentioned it. I think to address that, you have to do some very simple things. You know, today, just try and register a company which has got crypto in its, memorandum of articles or articles of association. You can't. There's a huge bias. There's so many state governments that are doing pilots, etc. Even the sandbox, the RBI sandbox specifically prohibits crypto things coming in there. You don't get banking opportunities, right? Banks, there are just one or two banks which actually the whole system is dependent. There's no insurance, Indian insurance available. You're talking of consumer protection. allow them. So there are a lot of simple things, company law, registration, access to finance, banking, insurance, which you can actually provide for this whole ecosystem and make ease of doing business in Web3 better. That's the biggest thing. I think you're going to see everybody, whether it's Switzerland, last week, we want to be the crypto capital of the world. Vara want to become the crypto capital of the world. Hong Kong wants to become crypto capital of the world. And, Shekhar mentioned that India are the largest adopters and, we don't have something here. So I think we need to look at this in a very, very serious manner to see how we can actually create an ecosystem. Otherwise, we are choosing technology. We are saying, tokenless blockchain is better than token-based blockchain, and we are pushing everyone there and might make a mistake going forward.
Sumit, your point, and then we take the question first.
Yeah, I think if you look at the current landscape, on one hand, India is number one globally when it comes to adoption, 3 years in a row straight. India is number two when it comes to number of Web3 developers, very soon going to be number one in 2 years. That's on one side. On the other hand, what happens to businesses? Right at the time of incorporation, problems. You go to a bank to open a bank account, not possible. Taxation, 1%, 30% capital gains, no set off allowed. It is like holding Bitcoin, which has been the best performing asset class of the last decade, is a sin. It's treated like sin, right? You don't get support from banks, any fintech companies. People don't like to say the word crypto, whereas on the other side, there is everyone rushing and building companies, building innovative solutions. And what has happened is that very soon, we will see that the ecosystem is not developed. We have the users, we have the developers, but there is no infrastructure, there is no ecosystem that lets India compete globally. And that's a big problem that I see right now. On ground, it's difficult to hire talent. If current companies, domestic companies are not able to hire talent, how will we see the next crop of companies coming? It's impossible, right? So N number of problems. Singapore, UAE, US, these companies are welcoming crypto companies with red carpet. In India, companies are welcomed with the red tape, right? It's a problem. It's a problem, and I do believe that we need to increase the participation, government and private discussions in a structured format, in a defined format with some timelines, so that, and principle based of course, so that we have a path, we have a clarity. Otherwise, sitting in the current position, not keeping it a priority or keeping it status quo is not going to do any benefit. We will then again play the catch up, and we will then again be sort of losing out on what's happening globally.
Yeah. I hear the founder's angst here, but let's move to this question, sir. If you could please state your name and organization.
Good morning. Thank you. My name is Suresh Narayan, and been in corporate, now representing academia. I have a lot of students who gamble in crypto, for want of a better word. And I pose a contrarian question to the crypto community. I mean, I hear a common theme saying that there's lack of regulation which is impeding the growth. My question is, what has the crypto community done, like a mutual fund campaign of Amphi, to create awareness in the community at large, to kind of diminish the risks that an Aam Aadmi like me, an academician, perceives? Look, this is a risky asset. I heard you saying best performing asset in the last 10 years. If you go back, equity is the best performing in the last 30 years, superseding gold as well. What is the community doing to create awareness to say, look, it's the likes of, as she said, the last 3 years you have so many people vanishing. What is the underlying security to that asset? What is the community doing? You may also argue that 91% of people lose money in equity derivatives, so they might as well lose money here as well. Right. But what is the community doing to create awareness and say, look, we are not as bad as the people think us to be?
A valid question, especially looking at India and where the most new digital users are going to come from, right? They're probably not going to be as savvy as the urban user is. But probably, Sumit, you can start. Sekhar, you can take it. Dilip, you can as well.
Sure. A lot of that may not be visible outside, but Coin-D6 has been focusing on educating masses around and highlighting risk as much as possible in our all communications. We have educated 45 lakh Indians around blockchain technology, around Web3, not just about investment. Investment is one part of it. And investment, of course, are risky. But that does not mean the technology is bad. All of us use internet. But probably most of us started internet with gaming. We were playing games when internet was new. We did not know what will happen like 20 years down the line. So yes, there are some risks. There are a lot of risk, in fact. Investors need to be educated. They need to be aware. And industry is not big enough right now to be able to do mutual funds kind of campaigns because it has been curtailed. There are multiple nuances that we need to look at. But in terms of the industry, there have been a lot of efforts that have been put in. And I think what is missing right now is everyone coming together, but now with Bharat Web3 Association, we have industries coming together. It's like players coming together. It's not just exchanges. These are blockchains. These are fintech companies working together and making sure that we create the right framework so that investors are sort of always safeguarded. And that is the reason why we have been asking for regulations. Regulators have a oversight on us, have a watch on every activity that businesses are doing so that these things are sort of does not harm in future.
It's a very good question. So I think 60% of India is under 27 years old. And one thing we know about young people is that they will do what they will do, right? Our responsibility to the community at large, young or old, is threefold. And we say that as a global company. First is obviously security, right? You have to make sure that customer assets are effectively secure. And that is the lifeblood of any financial institution. So I'll come to the education point in a bit, but this is fundamental, right? And so having secure licenses in 22 jurisdictions, all of our ISO certifications, all of our SOC 1 Type 2, SOC 2 Type 2, all of these are baseline for what is a robust, resilient, and scalable architecture, technical architecture. We process 1.4 million transactions a second. And so you can imagine the scale of issues we face when it comes to compromise attempts on our infrastructure. And having processed $150 trillion $150 trillion worth of assets in the last 8 years, we've learned a lot in that process. So we know security is critical. Second is privacy and compliance, absolute non-negotiables. Third, to your point, Mr. Suresh, is education, right? So Binance Academy is a non-profit arm of Binance. And we have, to date, 60 million users around the world who are active on that platform. And what does the platform do? The platform has about 600,000 tutorials, webinars, information sheets, documents, doing one thing, sole purpose, is to educate. Because you have to know as an investor or a person trying this out for the first time, first fundamental core technologies. What is blockchain? What are distributed ledger technologies? What do they do? How do they operate? What are wallets? What are private keys and public keys, and how do they work in conjunction? You have to understand the technical architecture of what you're dealing with before you do anything at the financial architecture level, right? And so a lot of that effort in the last 8 years, and we've sunk a lot of time, money, and people into this, is to build that information base for our users globally. And this is accessible to people all over the world. I spoke to some gentleman last night who was asking, can I use that information to teach my students, because he runs programs? And I said, it's free for all, right? It's just there to educate. And so that, combined with our efforts with law enforcement agencies to weed out nefarious actors, it's a twin joint approach. These are critical. So education is actually how the next 1 billion users are going to start using digital assets, because the core traders are already on the platform. The next 1 billion users are looking at, can I unlock latent potential? Right? Can I use payment systems, for example, for simplicity and use? Can I look at crypto cards, for example? Can I look at tokenized assets? Like what can I get into? Because a lot of the standard asset bases have been unavailable to a large segment of the population, right? Because bonds, properties, etc., they cost a lot, upfront capital. But now we're looking at a model which can tokenize them, fractionalize them, make them available. Has to be done with risk controls. I've mentioned some. We do customer suitability assessment, just like banks and insurance companies would. So if you're getting into more complex products, you have to have either the skill, knowledge, experience, or the financial position to take on those products. So we do customer suitability assessment in key jurisdictions to make sure that we are only exposing people to the products they are suitable for, or vice versa, right? So these are all part of the measures we take. It's an ongoing journey.
So I think very valid question. So what at the industry level we've done collectively, we've done first kind of a customer or consumer protection guidelines, which everybody in industry actually follows. It means that you got to follow the FIU guidelines. It means that you need to follow the consumer protection laws, etc. It's on our website. The second thing we did was token listing. We actually use best practices around the world. We have taken out a token listing guidelines. So, one of the big things in this world is that there are good tokens and bad tokens. The bad tokens are called something else, but let's not talk about it here. The third guideline, Shivani mentioned about all the unfortunate hacks, etc. We brought out a cybersecurity guidelines. We work very closely with Certain on that. Recently, Certain updated their whole thing, and we are actually doing that. And we are now looking at an investor education guideline, which is based on the MAS model, where when you onboard somebody, you have to actually do something, which I don't think the mutual fund industry is actually doing right now, but we are even looking at that going forward. It's in the final stages of that. So, and we brought out a whole campaign, a 100-day campaign on social media, because that's where all these people are of what to do and what not to do. And we are continuing that currently. So we are trying, but as Subit mentioned and as Shekhar said, that X percentage of your investment in mutual fund goes into AMFI, who then drive that thing. We are not there, yes, but hopefully we'll get there soon.
Right, this is all the time we had. I have been told that I've already taken a few more extra minutes, but thank you for the audience, and thank you for the panelists here. Really good discussion. Thanks.
Thank you very much. What a fantastic start to the day. And the point that really came out is the need for to regulate the sector for various reasons, that regulation will also give roadmap, but it's also critical for investor protection. May I please ask you to stay on stage for a minute? We have some mementos and pictures also as well. Can we have the mementos? Also wonderful, but there were so many takeaways from here, including that point on the entire contradiction of the ecosystem, the highest number of high adoption, the high number of developers, but no ecosystem or regulation to really give the guide map to the sector. Ladies and gentlemen, we have in the Chintaman Deshmukh Hall at level 3 right now Mr. Ajay Seth, a conversation with him, Chairman, Insurance Regulatory and Development Authority of India. However, we will be back in this hall at 11:20 for a really wonderful session, which is on where are the rich investing. Sure, a lot of you would be interested in knowing that. Just announcing once more that 11:20 we will be back in this hall for a session on where are the rich putting in their money. Could we also request the people who are outside to please coming to the hall? Okay, ladies and gentlemen, thank you for your patience. We're just going to begin now. And this session, I'm sure, will have your interest. The question we are asking is, where are the rich investing? And wouldn't we all want to know? Is it real estate? Is it equities? Is it gold, which has been doing phenomenally well? Or are they investing in collectibles? For instance, the art market is practically on fire, and Indian art has been doing especially well. We just had a record this year in an MF Hussain, which sold for rupees 118 crore. We've had Tayyab Mehta, Gaitonde, all of these works, modern masters and contemporary artists. Or are they also investing in, say, limited edition collectibles, luxury watches, which are also, traded, or jewelry by royalty, which also makes it to auction houses? Let's find out. May I please first invite Business Standard Markets editor, Mr. Sammy Modak, to steer this conversation. And may I now invite our panelists. We have with us Mr. Rahul Jain. Mr. Jain is recognized for evolving the retail advisory business. He's the president and head of Nuvama Wealth. He's recognized for evolving the retail advisory business into a full-fledged wealth management business. Mr. Anas Rahman Junaid. He's the founder and chief researcher of Hurun India. Under his leadership, Hurun India has become a trusted platform for wealth creation research, and it's known for its credible lists such as the India Rich List, Future Unicorn Index, and India Real Estate Rich List. Recently, you would have also read articles about Shah Rukh Khan making it to the $1 billion club. That was their list. And we have Mr. Rajesh Saluja, co-founder, CEO, ASK Private Wealth. With close to 3 decades of experience in wealth and capital management, he has been instrumental in establishing and growing ASK Private Wealth and multi-family office businesses since joining the group in 2006. We also have Mr. Shrikant Subramanian, co-founder and CEO of Iconic Wealth, an omni-channel wealth management platform for India's high net worth and ultra high net worth investors. Under his leadership, Iconic Wealth has grown to manage 6,000 crore in asset under management in 9 cities. Over to you, Sammy.
Thank you, Vinu. Good morning, ladies and gentlemen. Thank you for being here. The domestic wealth management industry is undergoing a remarkable transformation as the country's economy expands and the affluence deepens. The number of high net worth and ultra high net worth individuals is growing faster than ever. Today we discuss how the space is evolving with some of the key stakeholders from the wealth management space. I would like to begin with Anas, who, if you can set some context as to how this space has evolved and how the number of HNIs and HNIs has been going up.
Hi, thank you. Thanks for this opportunity. So we published something called the Hurun the Wealth Report, which is trying to understand the distribution of millionaires and millionaire households and macro level wealth creation across the country. And initially we used to do it every year, but then we thought we'll take a break and give a pause into it, give a 2-year gap and then do it, because these are sort of numbers which you can say and you cannot really go and count. So whatever we say, it has to be backed with some kind of assumptions. So to 2021 was when we launched the most previous report, and that time we found about 4.5 lakh millionaire households in India. And fast forward 2025, which is a report that was launched just last month, that number is doubled to almost 8.5 lakh households, millionaire households. Now, during this time frame, the GDP of India grew by almost $1 trillion, right? And some of the other numbers that I can share with you, which is kind of representative of how things were, right? For example, the number of billionaires during this time frame in the Hurun Rich List, that's grown from 220 to almost 360. That's grown by almost 50%. Or if you look at the number of individuals with rupees 5,000 crores net worth, which we could find, and we would have missed a lot of people as well, that number has grown from 324 to 581. So that number has grown as well. And so that all that happened when India's GDP grew by $1 trillion in the last 4 years. So, and we, based on the current growth rate, the GDP is projected to hit almost 6 to 7 trillion by 2030. We don't want to say double and all that, but 6 to 7 trillion, right? And that's an addition of 2 trillion. For that 2 trillion addition of GDP to happen, we estimate the number of millionaire households has to grow double the size of current levels in the next during that time frame. So I think from a wealth creation standpoint, the wealth improvement standpoint, it's really the India is on steroids. That's what we think.
Yeah, that would be music to the ears for.
We should invest in all these companies when they go public.
But Rajesh, if you can tell us, how does this compare to, like, say, mature markets like maybe the US, and are we have we like barely scratched the surface, or how's the market look? How does the market look like compared to some of the mature markets?
So I'll just compare it with the US. India has about 1,600 odd billionaires. The US has close to 11,000 odd dollar billionaires. When it comes to HNIs, we have about 550,000, 6 lakh HNIs, which are dollar millionaires. And the US has close to 34 odd lakh of dollar millionaires. And when we define ultra HNI, anyone with $25 million worth of net worth, India has roughly 45,000 and the US has 3,20,000. And outside the top 10 big wealth management firms in the US, if you take all the big names, JP Morgan, Morgan Stanley, there are 250 wealth management firms itself catering to that market, which is 8 times the size. In India, all the wealth management firms put together, we are about 25, 30 odd if you include the banks. So huge growth pathway for growth, and both HNI, ultra HNI are growing at about 8 to 9% in India itself. So there's a big runway for growth and for all wealth management firms.
Thank you. Rahul, we saw Rajesh and Anas throw some numbers at us. Are you also experiencing this in terms of your business, and how is it shaping up?
Yeah, very similar. And I must say, Anas, since you think India will have more millionaires and billionaires in coming years, you should publish a report every 6 months, not a year. And you should not take breaks since it's anyways on steroids. I think very similar in terms of what we are also experiencing. This whole trend of financialization from investment point of view is happening in the last 10 years. At least in the first 5 years, we used to see a lot of young people adopting into the newer asset classes like mutual fund, equities, etc., and were trying to experiment more. But what I've been seeing, at least in the last 3-4 years, that the older generation, which was more glued to the traditional classes like real estate, gold, fixed deposits, they are coming with loads of money and saying that what should we do with this? For example, I meet a lot of clients who come and say that I've sold this parcel of real estate in Gurgaon or Chennai, and what should do about this money? And I say that is a far accelerator in terms of leading to more wealth generation or more investments on the financial side. Because from wealth point of view, the older you grow, the more you have from investable point of view. And earlier, I think the younger generation who came had a lower investable surplus. So when the older set of people come in, I think it accelerates the journey more faster from the wealth point of view and for the whole financial issue point of view.
Thank you, Shrikant. I would now like to come to you. You're a new firm which is growing well. Can you tell us what made you foray into wealth, and what are the how has been the journey so far?
Look, I think the why part of it has been answered by my fellow panelists. I think the way the market is growing, the way we are seeing newer sort of entrance into the investing space, whether you look at it from a demat growth point of view, you look at the newest folios growth, I think that part is now well established. Where we thought that there could be an interesting play also is the intersection of what happens when domain meets technology. And I think that's one area that we intend to sort of explore a bit further and see if we can expand the market more horizontally. And there are two reasons for it. One, from an investor point of view, most of the investors in the tier 1 cities get very well serviced. And that's not to say that many of us are not trying our best to service investors in tier 2, tier 3, but without using technology to have a wider range of services available to a wider range of audience is that much more difficult. Two, from a point of view of wealth management itself, it's a very interesting industry, and most of my fellow panelists are veterans and they will sort of also concur with this, that it's a unique industry where the cost structures are similar to an investment bank and revenues are similar to an asset management. And till about half a decade ago, it wasn't the case. You had extremely high front-ended costs and you had extremely high front-ended revenue. But over the course of the last 5, 6, 10 odd years, the regulator has made sure that for the purposes of alignment of interest, most of the revenues in wealth management industries are now back-ended in nature. So for all of us to add productivity and efficiency, you need to start moving towards keeping your operating costs in check. And one of the best ways to do that is technology. So for us, I don't think we're trying to do anything unique or remarkable. We're just trying to take some of the more logical manifestations out here, adding productivity from a wealth management point of view, and adding choice of services to customers, which you otherwise will feel difficult to cater.
Thank you. Now let's learn how have been the investment trends amongst HNIs. Rajesh, I mean, a lot of your clients would require advice, some hand-holding, and we have seen the equity markets go through a volatile period. So how has their behavior changed? Are they now pivoting towards gold, or what is the interesting trend that you're picking when it comes to?
So we are largely in the ultra HNI space now for close to 40 years. The behavior with ultra HNI is a function of their experience in the market. If they've seen 1 or 2 bad cycles, patience level is much better. Our model always is around asset allocation, so not chasing a particular asset class. And the concept of asset allocation comes in only because we know that each asset class works differently during different phases of time. So there are times when equity doesn't do well, but then you have fixed income or other asset classes that are providing the returns. So in the last 1 year, markets have consolidated. Some good fund managers have still delivered 8-10% return. And there is patient money that is waiting in the sideline to see if there are any deeper corrections. So no one's taken any cash call. People have remained invested. Yes, there have been certain asset classes that have done well. So last 3-4 years, for example, we've added gold in all client portfolios. Last year, we added a little bit of silver, which is just 5 to 10% of the portfolio. Fixed income threw up lots of opportunities when equity was flat. So on the alternate fixed income space, between private credit, real estate funds, real estate NCDs, long short funds, there are lots of new investment vehicles that are delivering 8 to 12% kind of return that many clients invested. And last but not the least, as a model of asset allocation, we've always proposed 10% of their portfolio allocated globally. So for the last 4 years, we've invested in the US and continue to have a portfolio outside India through LRS route. That itself has done very well. So by just focusing on asset allocation, we are able to manage all the ups and downs variations of each asset class.
Yeah. Thanks. Rahul, what are the kind of queries that you're getting with the markets not going anywhere over the last 12, 13 months?
So, I would say that what Rajesh also spoke. So I would say that there are two sort of clients, at least when we look at when the market has been very stagnant for last 12, 18 months. So one is that category of clients who are very super bullish on equities and they will remain. So for them, it's always an opportunity like now where they want to invest more. So they want to go all in because they feel that market has consolidated for last 12, 18 months. And now there's be the new way of, or the trajectory where the markets can go up. And obviously there'll be certain things which have also happened in last 3-4 months like GST cuts, a lot of positivity in the markets, etc. The other camp is someone who was always circumspect that whether it will do well or not do well. They have started doing a different sort of allocations as well because they might are thinking that whether I did a right thing of investing in equities and whether I should have done fixed income. So their allocations have started moving toward fixed income, InvITs, gold, etc. And also what Rajesh alluded, I think we also speak a lot on asset allocation. And I think that is the best mechanism from risk management point of view, right allocation point of view. We keep saying that asset allocation is the best check for your emotional quotient also because at the end of the day, beyond a point, IQ does not work in markets, it's EQ. And if you have a right asset allocation in this current times, you can move your debt to equities. But if you're fully equity allocated, then it becomes difficult. So from that perspective, I think there are clients who are super bullish, who wants to continue investing. They find it an opportunity. But they are set also now who wants to diversify into the different categories because they are saying that in last 18 months, it has been almost zero. So whether I want to do something different, that is something in their minds now.
Anas, you deal with a lot of data. So the young cohort, is there some peculiar pattern there when it comes to their asset allocation or their portfolios? Are you picking any different trends, various generations? Or
no, I would just add. I don't manage wealth, so I can just add based on my interactions with some of these young entrepreneurs and family businesses. So I invest in a lot of startups. So I was just talking to one of the next generation entrepreneur of a fairly large $3-4 billion net worth family, and I was telling him that oh, I'm going to invest in a startup. At least you should start allocating some money because if I am investing say X, you should at least put 2X. That is your way of giving back to the nation, sort of thing. So they are a large real estate company. Then I told them this is the company which I'm going to invest in. The next day I get a call from their EA saying that can you give me that is my account number, so that they want to transfer the money. That's not the way it works. There's a whole due diligence, SHA, all that stuff that you have to go through and then invest. So there is a lot of beyond the core businesses for the traditional families. I mean, Rajesh and everyone who sits here, they play a huge role in educating about these asset classes, what is there in the market. Such a huge role because many a times they're so focused on their core business, some of the other opportunities may not get their attention.
Shrikant, your ticket size is relatively lower. So do you see a change in behavior when it comes to different age brackets?
So we cater to two kinds of customer cohorts. So from the wealth tech point of view, we range anywhere between 1 to 25 crores. And on the ultra high net worth, which is something that we've done over 2.5 decades, is where we start at 25 crore plus. But one of the things that we were very focused on is we don't want to have differentiated offerings to both these customer segments because that's something that has been the peril for a very long period of time, that you have smaller wealth and hence you will be treated differently, your service levels will not be that good. And I think one of the things that some of the big techs have shown us, and I'll take a classic example of Amazon. Even if you're an Amazon Prime member, your UX is pretty much the same. You may have certain other advantages like same-day delivery, or you may get certain discounted benefits, but it doesn't mean that your color of your app changes. You are not made to feel good or bad based on the amount of purchase that you make on Amazon. I think it was time for Indian service industry also to embrace that. So for us to have a change in terms of customer cohort was not to actually differentiate between those two customers, but actually to say that if we have successfully advised some investors over multiple decades on the 25 crore plus segment, going all the way up to $1 billion at times, can we bring some of those? Because all human beings behaviorally are aspirational. They want to achieve what some of the other richer investors have been achieving. So I think using technology, using regulations, we are trying our best to fractionalize some of those investments to the cohort, which is 1 to 25 crores. And there we have adopted an omni-channel approach, where the client is free to choose between choice of an app or choice of an RM. 25 crore plus, emotion does take better of you, and when you're about to make a significant exposure into an investment, you do require that human validation to check. So I think the way we do it is we diligence the product almost as if it is suitable to the very best out there, and we try our best using regulatory frameworks like accredited framework, SIFs, or certain other technology available to see can it be made available to a wider mass. And it is something that internationally, using omnibus structures, using blockchain, is now being done. So I think as far as we are concerned, one of the other things that we have as a philosophy, and I think Rajesh, Rahul, everyone spoke rightly, I don't think any wealth manager worth their ilk will ever contest against the age-old asset allocation. The only other thing that we try to add on top is also to minimize information arbitrage. I think one of the biggest issues that we see is in a herd mentality kind of an approach, and Anas just gave the example. I think one of the biggest things that we take as a responsibility for us is for every new asset class, every new product out there, can we minimize information arbitrage? And there are so many complicated products, right? I mean, SIF looks simple because it's coming from AMC, but it has almost 20, 30, 40% exposure to instruments which are not the most simple to deconstruct or demystify, whether it's early stage investing, whether it's private credit, whether it's private equity. So in addition to suitability and asset allocation, if each one of us can just raise the bar on minimizing information arbitrage, I think we will cultivate a much better wealth management ecosystem.
So yeah, technology has been a great leveler, and it's heartening to learn that even in the wealth management space, the same thing is playing out. But Rajesh, a firm like ASK, which caters to the HNIs and UHNIs, that also be making your job difficult. So if you can tell us what value a firm like ASK adds to this, this space.
The usage of technology? Is that
no, my point is since technology is sort of democratizing investing, for a firm like ASK, which has to sort of do a lot of advisory, what value does you add?
So Ultra HNIs, it's still very one-on-one, personalized, customized, relationship-oriented business. HNI is, for us, is a phygital model where we are using digital technology along with relationship managers. But for both the models, for us, technology is about how to add value to clients, be it portfolio analytics, observations, onboarding, servicing, many areas which today are manually dependent. So the idea for us, the final objective of using technology is how can we improve the productivity of a relationship manager in a way that he can handle many more clients and spend more time on relationship management rather than back-end work. So there are lots of AI-oriented technologies we've integrated within our system. A client, if he gives us details of his portfolio, we don't need a portfolio analyst to sit down and come up with analysis of which fund is doing well, not doing well, how to move portfolios, what is the risk. So all of the analytic part is done through technology. Then we use Microsoft Copilot, where we feed in all data, and we've been training our machines, any detail of products across all asset classes, because many relationship managers are not fully trained. They can get all the information, comparison, and now we are integrating it with our mobile app so that even a client can get all the information he wants. He need not call a relationship manager to ask him, hey, listen, I need some money off my portfolio, which fund should I redeem? Automatically using AI, the machine can tell him that he can exit out of ABC fund because it's poor performance or exit load is lower, etc., etc. So for us, technology is an enabler to improve productivity, to make sure that the RM spends more time with clients, because HNIs and Ultra HNIs still want that. And while democratization of funds is happening for the mass affluent, we still feel that many of these products are not suitable for the mass affluent. For us, when someone has surpluses, the investing should be easy and simple. The best way to play India's growth story is equities, and a good combination of equity, fixed income, where many people are still underinvested because they've either been buying real estate or gold or FDs, they can easily meet their long-term financial goals. Instead of trying to get into very fancy products, which ultra HNIs today want, because their risk appetite is higher, their portfolio size is larger. So some portion of their allocation, they're willing to look at private deals or geographical allocation or get into alternate products, which frankly for us are not suitable to a larger client segment. So that's, each house has a philosophy approach, there's no right or wrong, but finally for us, technology is about how to provide the service to clients at a much faster way, more analytics, and get our RMs more and more productive.
Rahul, if I can ask you the same question, what value can a wealth management firm add to somebody who wants to, invest a big sum in them?
So, I would say that from a wealth manager point of view, generally why, I think the basic premise is that why a client comes to us and what does he want? He wants someone who can help him compound his wealth over a period of time. This is, if you look at it, is a long journey. It can't happen in a year, 2 year, 3 year. It has to have a consistent, disciplined approach coming in. So, for example, when I was saying that asset allocation more than anything else, it's a best EQ mechanism, because end of the day, as a investor, and where there is so much of information coming in, where TVs are constantly telling you, your friends are constantly telling you, I think you get distracted. Suppose you have built a equity or SIP portfolio for 10 years on the line, but if market goes 10% here and there, you will say, I want to wind it up, hypothetically, correct? So getting a consistent and disciplined approach is very critical from creating compounding from wealth point of view, if you're looking from 10, 15 years of horizon. That is where a wealth manager comes and helps you out, giving you a guardrail saying that don't get disturbed, it is the right time to do some allocation here and there. And I think that conversation becomes very meaningful. Another important point is that in the current market context, every investor has multiple wealth managers. And most of the conversation right now are limited to product. It will become more meaningful from an investor point of view to move into a portfolio conversation, that how is your portfolio compounding over a period of time. And I would say that these are very essential part from creating long-term wealth. And there, I think a wealth manager plays a very important critical role. Apart from that, if you see from the current market landscape, there are a lot of mutual fund schemes, mutual fund companies, AIF, PMSs. What suits you best is also where a wealth manager plays a very important critical role. And because it's getting overcrowded right now. And a client can get confused very easily. So that is also a very important role where picking up, choosing the right product category, right product set among the category also becomes important. Because end of the day, the aim for a wealth manager, why the client comes to us, is also that someone who can generate an alpha for me, someone who can generate better returns than FD or other equivalent asset classes. That is the core work, and how I can create compounding over next 10, 15 years.
You said product is a key talking point. What about fees? Are fees is something that sort of helps one firm differentiate from the other? Srikanth, if you can. And given the competition as free...
I was not the first one to go on that question, but look, we are a cost-sensitive nation. I don't think that's any big surprise. But also in some sense, you have to look at the question of fees in terms of what value you can add. I think most of the time this question is valid or invalid, because if you're just adding a very commoditized kind of an approach or a service, you'll always be challenged to the fees that you can charge. But I think most of the, and I can talk for at least the panel sitting here, I think if it's a very purpose-based service that you do, if you can add convenience using either technology or high-quality domain services, using your own in-house research to add alpha, as some of us said, I think as long as the customer can see through what benefit he or she has by employing a wealth manager, I don't think fees is an issue. And on the other side, I think we've really seen the regulator disintermediating the industry to some extent. And when I say disintermediating in a positive way, that they do believe that cost needs to be more rationalized for the investors to have a slightly wider financial inclusion. So we don't look at fees as something which, it is an issue given the fact that there is overcrowdedness, but it is also pushing all of us to go back to the drawing board. And instead of saying that can we have a race to the bottom, the discussions are now shifting towards the fact that, look, if you have to charge fees, what's the justification to it? And I think that there's only one winner, which is the investor, because now, after a long time, the discussions are back to the boardroom where you are justifying what fees you're charging and for what reason. And if you have a good, solid justification, I don't think having a transparent fee is absolutely of no issue.
Rajesh, would you like to add anything? I mean, what are the key talking points? Is it fees that differentiates one firm for the other, or it's much more than just fees?
No, it's not. If you're adding value, people are willing to pay the fee. It's also become very transparent, so clients also know. Even if you don't tell them, competitors will. So you have to be sure that you are in the game. And you have enough and more investment ideas through which you can generate significant amount of fees. So I don't see fee as a big challenge. Having said that, in our business models, we've always assumed that over a period of time, you have to play the game of scale, because fees will get marginalized in some way or the other, because cost of hiring is always a challenge in the industry. You don't find talent. So as Shrikant mentioned, the model is of investment bankers when it comes to cost. And while fee paying, there is a limit to it. So 50 to 60 basis points is a average fee a wealth manager makes. And that's what has been built in the model. And you also assume that if this were to go down, because globally, if you look at all wealth firms, they earn without leverage about 30, 35 basis points. And then they use their balance sheets to make more money. And most of them are making anywhere between 70 basis points to 1%. In certain countries like UK, the regulator has come in and defined the fee. Yeah. So if you're a accredited investor, you can have a bilateral arrangement and charge whatever you want. But otherwise, for all advisory, they've capped it or they've put it as 0.75. So they've made everyone on the same sort of platform. And then it's about how much value you are adding in terms of services and products for which the client will give you money. So we may also move there. I think the regulator has a lot to do in the wealth management space. It's highly unregulated. People sell all kinds of products. There's no accountability. Half the relationship managers, are just sales guys. I mean, if you really drill down, they don't understand half the products. Anyone can become a relationship manager, and today anyone can ask for any kind of salary. So I think there is a time to, for this industry to get regulated, accountable. RMs should have certifications. They should have definitely some credentials before they can go and give gyan to others. And after that, even wealth management firms should have accountability in the way they drive the entire business model. So I think it will happen. It's a matter of time. 20 years back, there were 4 firms. Today, there are 25 firms. And as the industry grows, I think regulator will play a big role in trying to build credibility behind this industry.
That is a very important point. Rahul, what would it take to improve the quality of relationship managers and the touch points that are there?
I think that's an interesting one, and we grapple on this every day. So I completely agree with Rajesh that end of the day, it's our fiduciary responsibility towards the client to be true to them. And I think the wealth manager plays a very important critical role here, effectively. I would say that it is the overall culture and ethos of the organization also which drives the organization and drives the wealth manager. Because at the end of the day, if you keep asking revenue from him every day and you expect him to do something else on the ground, it will not happen. So first, the culture has to change from top down. I think that is one of the first and foremost things where you have to be comfortable in the space and don't expect moon out of them from 6 months, 12 months, correct? That is one of the things which is important. Another important thing is that if you can build a efficient cost structures, then automatically the need from wealth managers, like what Shrikant was alluding to, it's an important one. Third is that learnability and pushing the individual from learning point of view is also critical. So for example, we keep talking in our organization very regularly that end of the day, if everyone gets a gym subscription, I think 90% will still not end up going. So you can't force them. But learning is something which we have to force if the individual has to stand in front of a client. And everything can't be just explained or sold to client on relationship basis. I think it is very important for him to understand the product category, understand the asset classes, understand the asset allocation, and then speak to the client. And as what I was saying earlier, that this whole discipline as a process for client from portfolio thinking, etc., is also very important. A wealth manager work does not get over when he sells a product, and his work starts again when you want to sell it again. I would say his journey starts from every 6 months doing a portfolio review with clients. That is the most critical part. In that process, if he ends up doing something with the client, is ancillary. That is the thinking which needs to be done. And I am a firm believer that since we run a very large franchise from people point of view, we have more than 1,000 RMs. I think that is where we are trying to work, where we are using technology to help them from learnability point of view, create a more robust process so that there are counter checks from governance point of view. And third, building a culture where he automatically gets aligned to the client. And I'm sure that if someone, so I would say that obviously you can't change it in a very short period of time. It's a very evolving culture from point of time. But if you will consistently keep working on it, you can have significant improvements.
Thank you. We'll go to the audience but before that, if unless you can tell us whether how smaller centers are now, coming to the fore, and or is it just sort of where is all the action in the big cities, or even smaller centers are now sort of.
So I have this. So today I was talking to Rupert Hujwa, who's a global chairman of Huron. So he was going to a place called Yangyin, it's like a panchayat inside a place called Wuxi, which is inside like a state, similar thing called Jiangsu, right? Like a small panchayat. He was saying in that small province, there are about 65 listed companies from that small place, right? So that's in China. For India, just to give you a context, when we launched the list in 2015, we could find some 25 cities, towns, villages beyond the metros from which we could find the rich list entrants from. That number is 113 now. Right? And number of individuals in these cities, it was 87 in 2015, now it is 755, with a net worth of 1,000 crores and above that we could find.
These are beyond 25?
Beyond the metros. Beyond the metros. Total wealth of these individuals beyond the metros, that was 7 lakh crores in 2015, now it is 16 lakh crores. There's people in the rich list. Number of dollar billionaires, that has grown from 33 to 125. Again, now, ASK, Private Wealth and Huron, we do a list called the Future Unicorn Index, where we've defined startups called cheetahs, which are those companies with a minimum valuation of $200 million and which could potentially go unicorn. This kind of shows the future of startup ecosystem, right? That number, Rajesh, was about 32 when we started the list 4 years back, and number is now 63. That's gone almost double as well. So if you look at the overall wealth creation beyond metros, that's quite interesting. And also look at the sectors from which this wealth is being created. You've got industrial products, you've got construction and engineering. So there are local manufacturing heroes, local real estate like sectors which is predominantly local. A lot of such industries that's really popping up from these tier 2, tier 3 centers.
It's quite amazing that even smaller centers are contributing. We have time only for 1 or 2 questions, but very quickly, if you can.
Hi. Thank you, everyone. Basically, putting across some light to the investment part. I'm Vikram Mehta, representing Lawrence Grant Advisory UK. Rajesh, specifically, the way you guided just now, people are going from here to US. But what we generally found in last couple of years, looking at political scenario in India, people want to come back to India for the sake of investment, the growth of Bharat, looking at that thing. How is a wealth managers or wealth company you all see on that line?
So I was talking about investment diversification, because you have a Wells Fargo in the US and you have a HDFC Bank in India. Business models similar, but we still don't have the Microsoft, Nvidia's, Apples of the world. So as an allocation to equities, many of the ultra HNIs look at 5-10% of their portfolio getting allocated to the US markets along with emerging markets, where there is still a significant opportunity. And from an asset allocation perspective, India is not doing well. You'll also have certain portfolios. So India's market last year was flat, but in the US market, the returns were 27%, right? So that is the idea. But having said that, there is a huge amount of interest. We have an office in Dubai and Singapore that caters to NRIs and foreign institutions. I've never seen this kind of attraction towards India. And that's also one of the reasons Gift City model is becoming a very attractive one. So clients are looking to invest. Currency is always a challenge. But today, no one can stay away from allocation of India. And all the parameters, 2,500 discretionary income, aspiration level, size, we all know the story. Plus, I think, the political stability over the last 3 terms, digital infrastructure that India has created, physical infrastructure that we are investing in, these are absolute solid stories, and brand India has never been stronger. So there is a lot of interest to come back into India.
Very sorry we have run out of time, but we can have one question. Yeah, please. Mike, if you can give the mic. Just one. Quick one. Yeah, please.
Hi, this is Girish and Nani here. My question to you, all of you, and any one of you can take that question. Which is the asset class which has moved drastically? You see the growth coming in and especially with the topic, where are the rich investing? So which asset class do you think is moving fast forward, and you think the allocation to that particular asset class is increasing as compared to the other asset class? And where do you see this going from here? Which asset class would be the future could be? I mean, equities we've seen, mutual funds we've seen private credit coming in. What is the next, or what is the next big thing? We talked about crypto also in the morning, and we heard about that as well. So where do you see, and what is the next asset class or next big thing for the ultra HNIs and the HNIs of the country? Thank you.
Also, yeah, please. Also, my colleague Vinu reference to art and various new forms of investing. If you can also touch upon whether those are also being looked at.
I think that Rajesh can touch upon. So I would say that if you look from an Indian context point of view, we as a group believe that real assets will do well in coming couple of years. So like gold, silver has been doing well. Commercial real estate looks good. Something to do with infra, REITs and all will do well. So one of the asset categories which we feel can do well is InvITs and REITs, which is still evolving. From Indian context point of view, infra, power and all, where InvITs, REITs come in, there has been a lot of investment already happening and a lot of public money coming in there, and it's actually fairly I would say risk-free, not the right word, but less risk and a decent returns there. So that is one of the asset categories where there is a lot of liking which is coming in, and it might find a lot of interest. I think regulators also started doing some work there. So for example, now REIT has become from equity from taxation point of view. Something similar can come in future on the InvIT side also. So this is one of the categories which is annuity in that sense, generating fixed income, very predictable, lesser risk, and it sets with an Indian context point of view where a lot of investments are also going. So we need more capital there. Like the domestic helped India in the equity point of view in last 2.5 years. We have been seeing consistently. I think this can be the new category which can grow really well.
Rajesh, anything to add?
Right. So for investors, by far equity is the best asset class, right? We have to just make sure with all our clients that they don't get carried away by FOMO and start investing and going all over the place. But having said that, REITs, InvITs, commercial real estate, very good asset class. All government assets and private assets getting monetized through InvIT gives you decent fixed income return. So that by far, I would say the alternate space, which was missing in India, it was largely fixed income and equities, but the alternate space, private equity funds, your private credit, real estate, REITs, InvITs, this is a very strong emerging asset class for ultra HNIs, including private deals and private transactions, pre-IPO. businesses like data centers today, or companies before they get listed. There are lots of opportunities that are available for ultra HNIs who want to take serious amount of risk. And that too, we cap it. Maximum allocation to such products are not more than 10% of any client portfolio.
Anything to add, Srikanth? Or,
I think both Rajesh and Rahul well covered, but just to answer factually, what we are seeing as a change, while I don't think we'll disagree to what is the right thing, but factually the three things that have seen the maximum uptick in the last half a decade or so is global diversification. I think Indians are trying to max out wherever possible, either through feeder fund routes, in mutual funds, or through LRS, or now OPI is a big topic of discussion, especially in the UHNI close circles. So we're generally seeing a huge uptick in interest towards diversification in global assets. The second is alternate space, and specifically within alternate space, private unlisted companies have caught a fancy. While we all know that it's risky, but it's in some sense also coming of age for a country like India. We need to have our Silicon Valley kind of moment, and I think if smart, intelligent capital chases some of these assets with, of course, all the guardrails and risk, I think in some sense it's also healthy. And last, we are also seeing a reasonable uptick happening on passives, where a lot of people are realizing that a low-cost product which gives you similar risk-adjusted return through passives. So in my, at least, experience the last 5-6 years, irrespective of what is right and how we guide, keeping that question aside, but where we see a lot of questions coming is global diversification, passives, and unlisted is where a lot of queries coming through.
yeah, thank you. We have run out of time, and as we heard today through this discussion, that the India's wealth management space is evolving, and we are just starting. So the road ahead is full of opportunities, and we'll hear more from them in the future. Yeah, thank you very much.
Thank you very much. I mean, do please stay for a moment for pictures, and we also have mementos. Very engaging conversation, and we found out various things, gold, silver, new investment vehicles, also investing globally, but also a word of caution for overall investors that what might work for HNIs and UHNIs might not work for everyone. Could we have the mementos, please? Also the question that, no one asset class, but agility and advice on staying diversification, being disciplined, and having a consistent approach. Thank you very much. Our next panelists are already here. Do please stay seated, everybody. People will really, everybody, do please settle down. Our next panelists are here, and we really need to get into the next session. Grateful if everybody could settle down, please. We have the next session that needs to begin right away. Can we please request everybody to settle down? We have the next panel discussion that has to begin. Our panelists are already here, and we are plunging into the next discussion ASAP. So I would request everybody to please settle down. Apologies for that bit of chaos, with the And thank you very much for your patience. Thank you. Do please settle down, ladies and gentlemen. We are just starting immediately the next panel discussion, which looks at the fintech sector from pocket to cloud, AI authentication, and the future of digital banking devices. Now, the fintech landscape in India is undergoing a transformation from the mobile app era to a broader ambient digital device and cloud-connected ecosystem. AI biometrics and device-based authentication, are becoming the backbone of securing digital banking payments. For example, recent updates in the UPI include biometric face authentication and wearable device payout pilots, indicating that the wallet is moving beyond the smartphone. To steer this conversation, may I please invite Business Standard Executive Editor, Ms. Nivedita Mukherjee on stage. May I also invite our esteemed panelists, Mr. Ripunjay Gaur, who is the Chief Operating Officer for Offline Payments at Paytm. With more than 2 decades of experience in fintech and digital payments, he has built and scaled multiple merchant-centric businesses across geographies. May I also invite on stage Mr. Sivaramakrishnan Ishwaran, CEO, Zoho Payment Technologies, and Global Head of the Finance and Operations Business Unit at Zoho. Mr. Ishwaran is passionate about building software that addresses real business needs. May I also invite on stage Mr. L. Guru Raghavendran, Senior Vice President, Product Head. He leads the lending product portfolio, driving innovation and sustainable growth in a fast-evolving financial landscape. Product Head, Essential Software, my apologies there. And also on stage, Mr. Mayank Sharma, who's with Google. He leads the Android Enterprise Partnership for South and Southeast Asia at Google, where he works with system integrators, operators, distributors, device manufacturers, and independent software vendors. Over to you, Nivedita.
Thank you, Veenu. Very good morning, everyone. Before we start the panel discussion, thanks a lot for all the panelists who've traveled from all over the country, east, west, south, from all over the place. So thanks again. So like the topic suggests, we'll be talking about devices, rising significance of devices in fintech. So we'll start with you, Ripunjay. Why don't you share your thoughts, and you take care of the offline business. So where does device really fit in there?
So over a period of time, say, in Paytm, we have started fintech or a payment business 15 years, but last 3-4 years have really changed because the technology is changing. And you're right that the device which used to be a passive node at the merchant counter or at the payment center has now becoming an actively engaged piece. So if we talk about that, earlier the device was just sitting at the counter taking payment. Now with that device moving to the cloud, it is just an interaction point. The data is captured, transactions are received, but all the functioning is happening at the cloud. And especially with AI coming up, and AI coming at a much lesser cost, as it used to be like 1 year back or 6 months back, the way devices are evolving and the way we see device evolving in the next 3-4 years is huge. Today, if we are talking about, say, Paytm legendary soundbox, we have recently launched an AI-based soundbox, which can not just take payment, but also solve problems for the merchant and consumer. When we were giving demo at the last event of GFF, there was a foreign tourist which said that I have a problem interacting with shopkeepers while I'm taking a payment at a tourist spot. Today, most of the shopkeepers are not able to interact. But with the help of an AI device, voice taking from a language and converting that into another language is just a small piece. So it is right that today it is not just the device or the passive device which used to be there with the help of the cloud and the intelligence behind those clouds that can actually change the game for a developing country like India.
Siva, I'll go over to you next. What are your thoughts on devices? What are the made in India things that are happening at Zoho?
First of all, thanks for this opportunity. We are actually living in interesting times where this generation is actually seeing a lot of technology changes. So we have seen banking or fintech, whatever way you call it, move from desktop to the cloud. Okay, so that was the first thing that we saw as a generation. And from cloud, it was like the connected cloud. So once things came into the cloud, then it's all about connections, right? From there, we saw banking actually getting to the contextual banking. Instead of banking being a standalone piece, I have to log into my net banking software and doing all the transactions there. It actually started moving into a contextual way. Like say, for example, banking or fintech can be contextually embedded into various things. Like say, for example, we ourselves at Zoho, Made in India, ERP, right? So contextually, you can initiate all the banking transactions from your finance software. So that's the way we envision things. Like, so we actually work closely with ICICI to launch this concept of connected banking way back in 2018. So from once it became connected banking, then it's all about the devices, right? Say for example, once it is in the cloud, then it is all about AI and IoT. So we saw UPI being through the connected devices, right? One excellent demo was done during GFF, where actually you can just pay your petrol charges right from within your car, connected devices, the device car dashboard getting automatically connected to your phone, right? So that's the direction in which you are moving, AI and IoT. So we are going to see phenomenal this thing, right? So as he rightly said, voice is going to be the primary interface in these devices. A lot of intelligence in the back end and making a huge change.
Guru, I'll come to you a bit later. I'll go over to Mayank from Made in India to Google. I think we should get Google's thoughts there on, do you need Made in India tools over there or?
Yeah, sure. Thanks, Nivedita, and again, thanks for the opportunity to be here. It's been a great experience for the past couple of days, interacting with a lot of folks in the financing field. So I'll answer that in two parts. So one is just in terms of what is made in India by Google itself, right? I'll give you an example. How many of you heard about Gemini? Probably raise of hands. Cool, that's pretty good. Hopefully somebody took a picture. But just on that, right, when Gemini Live, the application where you can interact and talk to an AI avatar, right? I think that what Tripunjay and Siva were also referencing to. So India was one of the select launch markets globally when Gemini was launched. In fact, Gemini then was launched in 9 Indian languages. So often when we go out on the field, we give out demos when we are talking with Gemini Live, and there is somebody who is demoing the device and he's talking in Kannada, but then, he's also coming from the Maratha belt, so he then switches to Marathi. So a lot of those things are being built in India and for India. Another example which I can tell you, I know we'll touch upon security as well as we talk about fintech, but within Android, we have something called as live threat detection. So let's say if there is a transaction or a call which comes in, and that call comes in and that person is asking you to share like a screenshot from an application, which incidentally happens to be a financial application. The platform is intelligent enough right now to tell you that this is a malicious transaction potentially which is about to happen. I'm very proud to say that many parts of that were actually developed in India by engineers based out of India. So there's a lot that's happening, made in India, in fact, made for the world. I'm sure you will be privy also to the latest investments that we have made in the AI hub in Vizag. But coming to the devices part as well, right, just to complete that circle, I think as both Ripunjay and Siva mentioned, so what has changed from a devices standpoint is, I'm sure you would remember your first mobile device as it may be. Full disclosure, mine used to be a Nokia 3310. Probably that tells you a little bit about my age as well. But the first Android phone came in 2008. Mobiles have shifted from being a delivery mechanism to a full compute mechanism. So as I work with many of the devices that I have, in my pocket today, and to the theme of, from the cloud to the pocket and vice versa, you actually have on-device AI capabilities left to be harnessed. We actually are working with a lot of banking institutions, fintech partners, who can actually leverage these on-device AI capabilities, and these are available right off the cuff on the device itself. So I definitely encourage you to leverage these opportunities which are available on these devices. So we have an open source model which allows you to do multimodal conversations on the device without it being, without it talking to the cloud. We have multiple kinds of flagship devices which have summarization, generation of a description of an image right off the box of the device. And I think there are a lot of, just FYI, globally we're working with a lot of banks as well who want to leverage these capabilities on top of the retail applications of banking. But just to answer your question, right, device is at the center of it being an AI compute engine rather than just being a delivery engine, right? So that's where we have transitioned to right now. Right?
Yeah, Guru, from the universe that you belong to, I think you can elaborate on the lending bit and how tech and devices and lending, everything is coming together.
Sure. Thank you for the opportunity. Hearing all my co-panelists on the devices, if you look at it, what is the purpose of using the device? You're still probably taking a loan, opening an account, opening an investment. The purpose remains the same. I mean, only thing is what has changed is you're doing through the device. So that's the key change that is happening along with AI help. What we do is once all this is happening, the purpose remains the same and the technology behind this should support it. Because when you open an account in a bank, it goes and sits somewhere. There is a software which takes it and it sits. Now the difference is instead of people walking into branch, they're opening the same thing through device. So does that back-end banking software support such things? Is it built for such growth? So that is the change happening in the technology world. If the technology is API first, microservices enabled, it will support all this. So we're focused on enabling growth as the growth on the front end happens through various mediums. Simple example is, I don't know how many of you have been to bank in the last 1 month. Any of you have been to the bank in the last 1 month? There's one person in the audience here. And when I did the survey last time, they've gone to the bank because there was a signature mismatch. Not for applying for a loan. They went because they want a signature mismatch. Or they've gone because they want to close a loan. They're finding it difficult to get the final papers to get the papers back. Otherwise, we've not visited a bank at all. Everything happens through the device. So what we focus as a tech is, as the growth is happening on the devices front, whether the tech is capable of handling such changes. You cannot build a technology where you think people are walking into branch. No, they don't walk into branch anymore. Because, for example, in the event of a closure of a loan, we expect person to come to the bank, collect his documents. The softwares are built that way, where software will not work unless you walk into the branch. I'm saying I'm branchless, so how do you manage it, right? So I think we're focusing on building softwares on the banking side, which will enable the growth with such growth in terms of devices, whether it is AI, etc. Second important part is, when I talk about lending, like my co-panelists talked about it, when you apply through a device, the fraud is not disappearing. The fraud is also getting complex. Today, there are at least 450 parameters on the device that is evaluated to check if this device is authentic. Is this the right thing? Is it not anti-money laundering? Making sure of all of that. 400 plus 50 parameters on a single device needs to be evaluated. Because as the growth happens, we have to take care of the quality growth. So how do you take care of the quality growth? So these are the things on the technology front which we are focusing today.
Thanks. So fraud, you've mentioned fraud, and that's the most relevant topic right now whenever we are talking about technology. So Ripunjay, for everything that is good, there are also the other sides that have to be managed. How do you handle risks? How do you handle fraud?
So you're right that for a banking or a fintech industry, the security is very important aspect. And a security card does not only talk about fraud or a financial loss, but since when we are moving towards the cloud ecosystem, there is always a debate of the data security also, because it is the financial credential of an individual which is at the cloud, and we have seen instances that they got leaked. So I think with over a period of time, those cases are becoming less. But yes, fraud is one of the challenges. But with the compute capability increasing tremendously today. So if we talk about 3-4 years back, the algorithms which banks or a fintech used to place to control fraud was terms of manual. That, okay, these are the UPI IDs, or these are the bank account, or these are the cards which have a high propensity to do fraud. So there were risks or checks which were placed on that. But as the time progressed, we have real-time computing capabilities, and we have real-time fraud check mechanism. Like how the device importance is, like in UPI, today you have UPI device binding. So if you have a device and your UPI ID is there, and if that device suddenly changes because your SIM is lost or somebody has hacked your OTP, you will not be able to do UPI transaction. So that has controlled a fraud to a larger extent. And as sir was also saying that when we have a device which is AI powered, we know who's the user, and we also know the profile of the user. So once we know the profile of the user, and there's the back-end data computing capability which is there, we can definitely control fraud in a better way. We know whom he's transacting to. So 3-4 years back, or I must say 2 years back, the fraud mechanism were controlled by who is the user. But now with the computing capability and the AI going up, the companies are using fraud prevention with how we pays. Because fraudulent customers also pay in a particular way. They do large money transfers to a bank account. They do large money transfer to suspicious bank accounts. So because of the device being there, we are able to control in a fraud much better way. But data security is one thing which, especially on the cloud, where companies have to work on. But I'm sure there are a lot of things which have recently improved on the cloud players also, which is helping the industry to grow.
Zoho, how is it managing risk? What is the risk mitigation plan?
So we, just in line with the various players in the industry, we actually extensively use AI engine. So we are relatively new to fintech. So we have been mostly on the SaaS side. So everyone actually knows Zoho as a SaaS player. We got into the payment space a couple of years ago. So we actually have an extensive engine, AI engine, which actually focuses on the fraud detection. In fact, the AI engine is so powerful because, as Ripunjay sir rightly said, earlier we used to have a lot of manual mechanism to identify the various things. Now, actually, the AI engine can correlate things in such a way that the fraud clusters can be easily found. Like, say, for example, there will be some link between some accounts, right? Someone using the same email ID somewhere, the same account to which the money would have moved from one fraudulent account, through which we can actually correlate and find the entire cluster. So in fact, we were able to find one such cluster a few months ago. It was a huge cluster. So we extensively use AI. And one other thing that I want to tell here is the cost of fraud. Generally, people do ask me that being in the fintech, the payment space, why cannot you reduce the MDR? Why should you charge actually some 1.x% or 2%? Outside India, it's much worse. Actually, it's like 2.9 plus 30 cents is the standard, right? So why cannot you do that? And one of the core reasons why players like us are not able to do that is because of the cost associated with fraud. So once we all work collectively, be it at the device level or the OS level or the tech level or the banking space, once we can actually collectively work, collaborate, raise red flags based on various parameters and empower the layer that is sitting at the top, we will be able to bring down fraud, and that actually can be a massive savings, and that saving can actually be passed on to the customers.
Guru, how good are the regulatory guardrails in India in this fintech universe?
Perfect question, because there are two parts to it. One we call as money laundering and anti-money laundering laws. The other part is the fraud. The money laundering is very well governed. There are reports as per the regulator which each bank and non-banking finance company has to provide on a regular basis. Suspicious transaction reporting, cash transaction reporting, etc. That is well governed, and in fact, we work with large banks like ICICI, SBI, where we build certain AI models also. This we call as a more of a regulatory technology, RegTech, when it comes to anti-money laundering. But if you look at fraud, fraud is more domain-oriented. It is not really regulated still. A credit card fraud is very different from a CASA account fraud. A lending fraud is very different from a payment fraud. So the fraud is an area which is not yet fully regulated. It needs to evolve over a period of time. As a result, if you look at a large bank, they'll be fighting fraud by having multiple systems, one for credit card, one for payments. And as a leader of fraud in a bank, if I want to look at a 360-degree view of a customer across, that will be missing today, because I'll have to look at different places for different places to look at it. So I think some help from regulation on the fraud aspect will be very helpful as we go forward. I'm sure all the regulation and the governments are thinking about it. But anti-money laundering is very well governed today. That's my view.
Mayank, can you give us some live examples from your company on how you're managing risks, frauds?
Yeah, sure. In fact, what I'll do is I'll split this into two parts, right? I think Ripunjay talked about who is the user, right, on which the fraud is happening. And then there is the actor, right? Now, if you have to split it and figure out what's the right approach, right? You have to look at the user, but you also have to look at the employees of these institutions, right? Because that's often where the acting part may start invariably, right? Just purely in the banking sector, right? There are approximately 2 million employees just in India. And banking or BFSI on its own, in fact, impacts approximately hundreds of millions of workforce. Now, if I have to start it on the user side, right? And again, coming back to just letting the audience know that there are capabilities across platforms which can be leveraged to talk about addressing risk. So I was talking about on-device AI. Just by the way, if you are using an Android device, we actually use on-device AI also to mitigate scam detection of messages. I encourage you to check out or just search for, Google Gemini Nano. Gemini Nano is the on-device AI model which sits on premium flagship devices. And it does have like a compute requirement which needs to be there on the device, but the repository of models that can leverage that model is hugely expanding. Then we also have an open source model called Gemma, which is multimodal. It can work on text, video, and images. And all of these models actually can sit on the device, and you can interact directly with them on the device. And you can give them this data of messages, of any application, triggers, which can be used on device as well directly. So that's on the user side in general, from a platform perspective. I also encourage you to check out the Android show, which in fact a lot of features that we have are very much anchored on security on the device, because what happens is you're using an application, you're accessing messages, you're clicking on a URL. I think these are the three typical vectors, right, of how fraud would happen on a device. We have mitigation measures across all the three. So that's one, that's the user part. On the employee part, and that's where I actually work very closely with B2B partners and institutions directly. One feature maybe which I can talk about right now is you have the banking institutions, right? Or you might have people working in the stock industry. Many of the regulations, at least globally, and I think that is probably still in evaluation in India, but globally, the devices which are used in the banking/financial industries are required to be managed when they are being used by the employees. In fact, we have a mechanism on such managed devices to archive messages which have been exchanged on that official phone to make sure, because there are regulations around logging of messaging, whatever is happening on the device. So we have a mechanism where you can archive this directly and have that as a repository at your end. So these are some of the select frameworks and messages that we have. In fact, I was just discussing with my colleagues just when we were sitting over for tea, that on these devices, we also have the capability to collect signals. From a security standpoint, these devices don't have to be managed, but let's say if you're using a financing application, let's say if you're using Slack on these phones, right? And you want to make sure it's being used on a secure phone on the employee side. So you have frameworks where you can get device signals before the access to the application, like a Slack, like a Salesforce, is given on the device itself. So I encourage you, so this is called as device trust. I encourage you to check that out as well. There are blogs out there. But that's how we at Google, specifically with Android, are addressing those kinds of frauds and risks.
Mayank, I have another question for you, and then I'll ask other panelists also. So if device is really at the center of things, coming back to our original topic, what happens to the cost? Because I was speaking to a telecom company, and they said 4G to 5G conversion is not happening at the pace that was expected because people are not buying those high-end phones. So is that a challenge? How can that be addressed? Affordability that IDAI chairman was also talking about, like we should keep that in mind.
No, definitely a pertinent topic. So in fact, see, and I'm sure this is something which you experience as well when you talk to a lot of the folks who travel globally and experience India, right? See, India is a land of patterns and anti-patterns, all right? So there's a lot of learning that typically happens from India for the world. Now, interestingly, when we're talking about the growth of, let's say the premium segment of devices, just last year, if you had to take the number of devices which were sold in the $700 and above segment, which is like 55,000 rupees and above, so we were ranked second in terms of total shipments, and we were tied up with Japan. So there is this dichotomy in terms of, a lot of the premium devices are actually being sold, and a lot of them actually are, choosing Android as a form factor. So that's one part. The second part is how can we enable in this AI world, right, to make sure that users and specifically employees of organizations can get phones or seize devices which have these premium AI capabilities at an affordable cost. So one of the ways that we are addressing with our device manufacturer, in fact, with our leasing partners as well, is while there are programs, of course, to make devices affordable, and that's more, on the lending side, which the other panelists can definitely talk about it more. There is something called as smartphone leasing, which a lot of companies are adopting. So this is an analog. I'm sure you would understand or know a little bit about car lease. This is an analog to that. So what happens is based on some frameworks which are established between the company, the person or the distributor who is selling those devices, and of course there is a leasing entity involved and an attached insurance entity as well. You're able to give out phones on a lease as an official phone to the employees for a particular period. What happens is the employees get benefits because of some of the taxation clauses. The employers also get benefits because they are not taking the full phone on their books. It's basically a service. And then we also have the option that once the lease period is done with, you can actually upgrade to a new premium phone, or you can basically potentially own that device back based on the buyback, price that you pay. So in fact, we have that covered, with our partners here, Brilliant. So in fact, it's called Smart Employee Purchase Program. I definitely encourage you to come, to our booth if you want to discover and learn more about this. But there are a lot of companies who are slowly adopting this. It's obviously takes a lot of time because this is about employer plus employee awareness in terms of why they should opt for this option. But this is definitely something which is beneficial for the employees and the employers. The reason why the adoption is scaling right now, because now we have the tools to manage the full life cycle of the device. From the point of entry, where the employee experiences that phone, right up to when he or she needs to upgrade, or maybe, just have that official phone being transferred as a personal phone. So these are some ways, net new ways that are being adopted, and many of these are actually coming from India and are being adopted across the world as well. So I think that's one part of affordability which I can talk about. There are, of course, other measures as well where we are trying to see how devices generally can be made more affordable via financing options. But that's, of course, a conversation of the device manufacturer, with the financing partners.
Guru, any problem-solving software to make things more affordable so that people from smaller towns, people from lower income strata, they can access devices through which they can get onto fintech?
For sure. I think the way I look at it, continuing from where Mayank left, banks exist because they need to lend. I mean, everybody puts in money, but at the end of the day, they lend, right? I mean, now the segments they are not willing to lend is where non-banking finance companies came in, because they are charging a little higher interest rate, they're willing to take risks. But today, if you look at the world, large players have come who have started this BNPL options, buy now, pay later. So literally, they say there's no interest to be paid. You divide it to EMIs, pay everything. So I think there are organizations we've dealt with who are only focusing on this segment. They don't do anything else but do BNPL. How does technology players help? The technology players have a tie-up with such payment providers. There's a pre-integrated tie-up so that as soon as you launch, it starts working and you go to market quickly, number one. So that's how the technology helps. Second, just taking a cue from Mayank, the fintech space, which is coming in today, it's all about data. I mean, everybody needs data, build data models, etc. So I've seen a specific focus area of a fintech who have gone to all leading colleges, right, and given them the phones where probably the class monitor or the leader of the class will collect money on a regular basis. So what happens here is, at the end of 2 years, you've built a behavior of each person in the class as to whether he's paying on time, how he's paying, etc. The moment they're out of college, you already have a behavioral model, not to worry about credit bureau and other things, so that you can finance them. So we're getting them into the financing world. So I think what is happening is two parts. One is the technology, since it's all API-driven today. API means exchange of information, just to simplify it. All the technology is API-driven today. There are tie-ups happening at B2B level, where we tie up with the payment providers already, have the technology ready so that you can implement for BNPL. Second, it helps to look at the alternative data, look at the data behaviors, which will help us give those financing models appropriately.
Siva, I will change the question a bit for you. Looking ahead, who do you think will shape the digital banking world? Will it be banks? Will it be fintech players? Will it be the technology players? Or will all of them do it together? How do you look ahead?
So obviously, we all have to do it together. There is no one player who can actually do it all. The device manufacturer, they have their own goal. The tech players, the banking, the fintech, everyone has their role to play. Most importantly, as all of us were talking about, each and every layer has its own set of information, right? So, say for example, the device has its own set of information, the operating system has its own set of information, the app layer has its own set of information, banks have their own set of information, each do their own KYC, like fintech do their own KYC, bank do their own KYC. The biggest problem today is like all this is segmented, segregated, right? So now if actually we can collaborate and we can empower each other, and if there are actually good standards which actually can help in this collaboration, then that is what is actually going to win the race. So the biggest difference will come from the ecosystem, not from the individual players. So when the ecosystem wins, everyone wins.
When the ecosystem wins, everyone wins. Ripunjay, your thoughts briefly on what is in future and what kind of R&D is your company looking at?
The way the world is changing every 3 months, it's like the wave of technology which is coming after model after model. So one of the thing is, we at Paytm definitely believes that it will be a game changing in next 1 or 1.5 years, how we transact, especially on the financial side. The form factor of the device can change because app today have icon-based browsing, but if the like ChatGPT or any Gemini, they are more voice-based browsing. So the apps will also change for good, because then the people will be just able to talk to their app. Okay, do me a recharge to my wife of 100 rupees. And why you need a screen for that? So the cost will also come down. The second is, it is a constant time that we have to keep our minds and the goals open, and we have to keep on see what is the end use we want to drive. Especially in a country like India, the end use is how we move from digital reach to digital trust. Because we know that UPI has also reached at a particular level. The next 30-40 crores of people need a simpler way of adoption. They need a more trustful way of adoption. It is not that they do not interact with apps. They are very good watching videos, reels, etc. But they don't have a feeling of trust while doing a financial transaction digitally. So that is where we are investing our technology and doing R&D, that how can we build a trust and how can we make them easy or convenience to transact digitally and add into the Indian economy.
Important point, digital reach to digital trust. We are coming to the close of the session, but we'll take a couple of questions. Does anyone have any question for the panelists? Yes, on the left. Brief question, pointed question.
Hi, my actual question is to Mayank, especially when these trends coming in with the Google Gemini regarding the photo uploads and all of those activities, and the DPDP Act actually kicking in. How are we actually going to ensure about the privacy of the users and how it is going to shape, in the future? Because that seems to be a very big risk, especially when the payment banks, everybody is sitting. So you know how the kind of risk is happening with the DigiLocker coming in and everything. So how will that shape, if you could throw some lights on that?
Yeah, so just to answer that question from the perspective of privacy, but also giving user control. If you look at Gemini, for example, you do have the controls to manage, let's say, your chat history. You also have the capability of managing, let's say, specifically in an enterprise environment, let's say, I think there are much more controls that you can put in. Let's say if you are specifically an employee working in a domain restricted environment. See, as we look at everything that we do globally as well, right? So, I mean, there are a lot of different privacy laws. There's GDPR, there's the California privacy law, and each region has its own interpretation. And as DPT, like as it comes into effect, right, we are closely watching in terms of what the guidelines and the guardrails are. But fundamentally, when our approach is respect the user. I think that's how we always develop our products from that point backwards. And that's actually laid out in practically all of our products. to make sure that we give the user the full right in terms of how they want to manage their privacy. And that's something which underpins all our products which are used globally today. We have about like 9 products which are used by more than approximately 1 billion people. And then there are 15 odd which are used by more than 500 million. So when we operate at that kind of scale, right, these factors are actually very important in our product development cycle itself. So that's the way I would look at it. And in terms of how Google also approaches it, that's also our approach.
Yeah, Siva wants to add.
Yeah, I will just add to it. See, when it comes to privacy, the most important thing that we in Zoho practice is data minimalization. That is, collect only the data that is really, really required. Okay, so, and be transparent about what data is getting collected, how the data is getting used, and where it is getting used. Okay, if we actually have this transparency, and if we can actually guide the user in using the data in the right way, like say for example, we have different layers, right? The apps, the device, and all this. So each of these layers, we own the customer and the customer relationship. But when it comes to data, none of us own it. It's the customer who owns the data, right? So we will have to guide the customer the right way so that he can actually use the data the right way across all the apps. The data moves between all the apps, but we actually have to ensure that the customer journey, customer is always safe, secure, and the privacy is always respected, right? So that's the key thing. So data minimalization plays a key role here.
Hope your question has been answered. Any other question? Last question. Yes.
Hi, I'm VC Sharma. My question is to Mr. Mayank. As you have mentioned that there is a Gemini Nano which works on a device, AI on the device. So, and it is able to actually identify whether there can be potential malicious transaction initiated from the other side in terms of financial transaction like scams. So can the device can also find out that who is actually originating that particular transaction and can block that transaction at the origination itself instead of taking it to the potential harm to the customer.
So I'll basically summarize. I think what you're trying to ask is there a way that once we detect some triggers about that transaction, can the transaction itself be blocked then and there itself? I think that's the gist of, I think, the question you asked. See, what we do is see Gemini Nano in its current stage, right? So we have the signals which can be provided to any application. So in fact, to all the audience out there, if you are working in a banking industry, in the insurance industry, in the fintech industry, right, and you are working on the mobile application layer, right, I definitely encourage you to just search for Gemini Nano. There are 2 sets of frameworks we have. One is called MLKit APIs, and the other is what we call as a AI Edge SDK. Both these are able to provide you signals. Both of these are primarily focused on text-based evaluation. The extra image pieces, let's say if you're uploading an image, then it can give you a description of what that image is, right? And these are all available on device. What we provide is a platform so that applications can then take action, right? So I think so once you start developing on that stack, I think that's when the application, individual application developers can then start to act on it. The other suggestion that I also have in general is, and I think a lot of application developers generally uses, specifically on the Android devices, right, there is something called as Play Protect. So Play Protect, just for your reference, it's not just Google's machine learning engine at play, because it actually scans 125 billion applications every day, because these are the number of applications being uploaded on Play Store. This is a consortium. So we actually partner with the likes of Zimperium, Elets, Lookout, where they also exchange their definitions of malware so that any vector which is out there which is acting in consort to do any fraudulent transactions, and the typical target is the banking industry or the financial industry. So this is how we operate. So it's a very robust framework. For all the application developers, make sure that you use the Play Protect capability and the Play Integrity APIs as much as possible. But as to the gentleman's question, I think this is something which you should generally check out. These APIs which I just mentioned, anchored on Gemini Nano, there's a lot that you can do. We are obviously using it as first party, but you can also leverage the same.
Thanks a lot, and we've completely run out of time. Thank you everyone for traveling this far, and we had a really good discussion. Thank you so much.
Thank you.
Thank you very much. Very engaging discussion started with, language diversity and how, including like helping shopkeepers engage with tourists, and then quickly to the security issue, which is really so critical now because everything is on technology, and that's what a lot of people are worried about. And thank you very much. Could we please have the mementos? And it was very interesting to know that there are, something like 450 parameters which are evaluated on devices to detect fraud. Another interesting thing was the concept of phone leasing. I don't know how many of us, here in the audience know about that. And the future of apps, which will be like apps responding to voice. And given the way, India is, how quickly technology is developing, that is bound to happen sooner than later. Thank you very much. Could we have some pictures as well? Another important point, and I would like to mention it, the need for regulation around the multitude of frauds, and not just anti-money laundering, which the regulator is looking at, but given the range of frauds that is happening, the need for regulation around those kind of frauds as well. Thank you very much for making time to be here with us today. Ladies and gentlemen, I would just, we are staying on the topic of AI and technology, and that is at 1:30 p.m. We have Ms. Arundhati Bhattacharya, Chairperson and CEO, Salesforce India. That will be at level 3 at 1:30 p.m. And this looks at AI and technology in banking. So at the Chintaman Deshmukh Hall, 1:30 p.m. Meanwhile, in this hall, the Narayan Vagul Hall, we will meet at 3:30 p.m. for the next session on microfinance, which will look at whether the worst is over for the MFIs in the current cycle. Thank you very much. Could I request everybody, we'll begin immediately. The panel discussion is on, is the worst over for MFIs in the current cycle? Now, the microfinance sector in India has had a difficult cycle marked by delinquencies, borrower over-indebtedness, and funding stress in recent years. However, more recently, industry participants such as the self-regulatory body Sarthan have indicated that while challenges remain, the worst appears to be behind them, provided funding support is maintained. That suggests a stabilization phase may be underway, though growth may take time to rebound fully. The view is that if MFIs can shore up liquidity, tighten underwriting, and benefit from improving rural incomes, the sector may shift from a repair mode into a cautiously growing mode. May I please invite on stage Business Standard Banking editor, Mr. Manojit Saha, to steer this conversation. May I also please invite on stage Mr. Alok Mishra, CEO of Microfinance Industry Network, MFIN. He has played a key role in regulatory reforms in the microfinance sector and has helped in establishing guardrails for microlending. Do please come on stage, and a huge round of applause, ladies and gentlemen. May I also invite on stage Mr. Sadav Saeed, CEO of Muthoot Microfin, a subsidiary of Muthoot FinCorp. Prior to heading the microfinance institution, he worked as Chief Operating Officer at Muthoot FinCorp. May I also invite on stage Dr. H.P. Singh, CMD of Satin Credit Care Network. He has been at the helm of the company's day-to-day operations and long-term strategy ever since the company's inception in 1990. And also inviting Mr. Karthik Srinivasan, Senior Vice President and Group Head Financial Sector Rating at ICRA, the Indian unit of global ratings organization Moody's. A huge round of applause again, and over to Manojit.
Thank you, Vinu. The microfinance sector has gone through several cycles in the last 15 years or so, several stress cycle, and they have come back also strongly. In recent memory, it started from the Andhra crisis 15 years back. Then there was demonetization, COVID-19, to name a few. The recent stress in the microfinance started sometime last year. When during the summer months, extreme heat wave conditions, started it. Then, of course, the regulatory embargo on a couple of microfinance institutions dampened the sentiment. Of course, the corrective steps were taken since then, which the MFIN, the RBI recognized self-regulatory organization, came up with guardrails, 3 guardrails, right? Today we were asking that is the worst over for the microfinance sector in this current cycle? Before that, I will go back a little bit and would like to ask the panelists about their view on a particular issue, which is that 2 years back, the Reserve Bank of India abolished the cap on lending cap on microfinance. Earlier, there was a cap that the lending rate should not be over more than 10 to 12 percentage points over the cost of funds, or 2.75 times the average base rate of 5 large banks. But that was abolished 2 years back. I want to know from each of the panelists as their opening remarks, do they think that the removal of the lending cap has the microfinance institutions were more disciplined because even if the regulatory cap were removed? So, Mr. Mishra, why don't you start the proceedings by sharing your views whether the removal of lending caps have made the MFIs more disciplined or?
Thank you. I think you are referring to interest rate?
Yes, yes.
Okay. See, let me first set the record straight. The deregulation of interest rates in India started in 1991. And even savings rate and small loans deregulation, everything was completed by 97. By 2022, you were in a situation that in India, entire financial sector of 300 lakh crores, only 70,000 crores of NBFC MFIs was under interest rate control. And NBFC MFIs had only 35% market share. Banks, small finance banks, mainstream NBFCs, no interest rate control because it was left to the board. And that's what the Indian financial sector thinking has been since 1991 reforms. To say that 35% of microfinance sector interest rate cap removal has led to problems, I think that's completely far-fetched. That's first of my opening remark. And the other point, let me also tell you that when we, in 22, if I take you back to April 2022, the interest rate average, weighted average lending rate of NBFC MFIs was somewhere around 24%. And today, when I speak to you, all of our MPN members, including all the panelists who are sitting here, the weighted average interest rate, which is displayed on our website, is 23.62%. So where is the problem that I am not able to understand?
So no, I didn't say where is the problem. I said, do you think that the sector has become disciplined, more responsible, or some of the institutions are taking undue advantage of the situation?
See, interest rates have remained same, as I explained to you by giving the data. The other part is, if institutions, just because they have the freedom to charge higher, they start indiscriminate lending. So there have to be two consequences. One, in India, the market, any district, if you go, there are 18, 15 lenders there. So you don't have that competitive edge that you will start charging 30%. If they start charging 30% or Saturn start charging 30%, they will not get market. Second point is that higher charging of interest rates should lead to profitability, higher profitability. Na? But if you look at last 8 years return on asset of the top 10 NBFC MFIs, it is the return on equity is 1.8% and return on assets is 1.8% and return on equity is around 8%. Which is equal to the risk-free rate of return of Government of India bonds. So on that count, I will not agree that that led to any problems with that.
Fair enough. Mr. Saad, Mr. talked about that a lot of lenders' competition ensured that nobody is charging more. But at the same time, India is a credit-starved society and MFIs lend to the bottom of the pyramid segment where formal finance has not reached, and even if it had reached, it charged exorbitant rates. So from that point of view, do you think the sector was more responsible following the removal of the lending rate cap?
Yeah, I think responsibility of the sector in terms of promoting financial inclusion, taking the credit to the last mile, you can see from the numbers itself. I think in 2010, before I think you were referring to a rate cap, it came after the Maligram committee. The whole of sector was around 20,000 crores of asset under management. Today, just before this year of a little bit of a low disbursement, the industry was at around 4.4 trillion rupees, 4,40,000 crores. So, and 8 crore households were serviced by a microfinance industry. So, I think from a purpose of taking the financial inclusion to the last mile, the industry has done a great job. And I think thanks to the government for providing that platform. I think Jan Dhan account, Aadhaar, mobile, all of these were really, really good tools to take microfinance to the last mile. But I think the discipline that you want to judge of the microfinance industry, I'll tell you, this is the only industry, and more particularly NBFC MFI industry, which is submitting credit bureau data on a daily basis of 8 crore loan accounts. 8 crore customers, loan accounts would be around 12.5 crores on a daily basis. And this was done voluntarily without any stipulation from the regulator. This was internally with the SRO's kind of initiative. We decided to submit that data to ensure that we know what is the exact outstanding of the borrower and what's the credit behavior of the borrower. So that's the amount of responsible lending. Coming back to the part of the interest rates that you're talking about, I think we have to put that into context. If you look at globally, and I'm talking about the microfinance globally, be it Bangladesh, be it Latin America, be it Africa, India would be the market where the interest rates are the lowest. And this is despite we don't have the benefit, especially the NBFC MFIs, don't have the benefit of taking deposits. World over, there is deposits available to these non-banking companies, and they are able to charge much higher rate. Latin America, the rates are 49, 50%. So I think not that we should be charging that, but the industry has been responsible. And RBI has been very proactive. And it is not overnight they have reduced, taken away the cap. It is a progressive move. Earlier, there was a 26% cap. Then it moved into a regime of margin, incremental margin, that 12% margin you
Cost of
talked
funds,
about.
yeah.
And then it removed it. Understanding the industry has matured, the SROs are there who are playing a responsible role. So there was an appropriate time to do it. And I think industry now is pretty much ready. It's well capitalized to kind of price the credit correctly. And RBI has given a very good formula. Your cost of fund, your credit cost, your operating cost, plus your reasonable margin.
Right.
And that should determine. And I think everybody is doing it transparently. That's what you want.
Right. Mr. Singh, in this context, how do you see the RBI embargo on a couple of MFIs because of RBI clearly said that exorbitant interest rate charged to the people who are at the bottom of the pyramid?
See, exorbitant is again a word which is, it can be misconstrued in any possible fashion, depending on the side which you're on. If you really ask me, technically, whatever rate we are charging, if you actually look at it, there are two sides to it. A 5% rate of increase technically translates into maybe a 10 rupee interest or maybe a 10 rupee installment increase in the borrower's repayment schedule as such. Now, at that level, bottom of the pyramid, where majorly, I think they are into retail lending, they are into, the kind of enterprises, what they actually do it. The margins are close to about 400 to 500%. 5 rupees, 10 rupees does not make any difference. So I think, that's the context which probably people are not able to really understand, And when we talk about this, this ultimately the market dynamics had to take over. You cannot grow an industry with your hands tied behind your back. So if you have a cap, the cap will be not conducive enough for the industry to grow. I think the moment the cap went off, I think it actually meant the market forces and the dynamics would come into play. Now, which will also lead to the way you handle your cost of funds, how your liquidity pans out, and the way you really want to charge. So it's a combination of all these factors, put together. But overall, if you really look at the complete, dynamics of how this has evolved, I think, this was a very positive step towards increasing inclusion, And I think it's not just a mere word which has been done, In fact, I think if you really look at it, RBI to create a specific license was probably the need behind it, And that was entirely why inclusion actually came as a mainstay at the bottom of the pyramid.
Right. Mr. Srinivasan, in your analysis, do you think MFIs are running more behind bottom line than top line? Earlier, the narrative was, we have to grow, we have to, expand the accessibility of credit throughout the country. But over the years, do you think that they are more profit conscious now?
As any industry matures, you would start becoming more and more profit conscious. So that's true for every industry, including microfinance. But for a vast majority of them, touch wood, as I see it, the focus is of the company owners, of the management, is towards increasing financial inclusion, getting people more onto the formal lending model. So that objective still remains. Yes, we can possibly say that, possibly last couple of years, the growth has been a bit too fast, and that's caused a little bit of hiccups, given possibly some mistakes happened at entities level, some challenges at the macroeconomic level, all sort of came up around the same time. But fundamentally, the business focus has remained on how much of more inclusion can you do. Today, if you really look at, let's say, a lot of entities are listed on the MFI space itself. So if you look at the analyst presentation, look at the commentaries that they give, there is a fair bit of commentary which talks about how many new to credit customers am I onboarding. So you are clearly seeing that the focus is there on that particular segment. Profit focus would come as entities scale up. End of the day, as an NBFC, you need debt. And for you to get debt, you also need to have your operating metrics in a good shape and size for lenders to give you money. So from that point of view, yes, profitability has become important. And in that role, the last couple of years, direct assignment has been a very good tool. It helps to an extent de-risk the on-balance sheet exposure. Because of the accounting rules, you're also able to sort of improve your profitability. Though we as analysts, we look at it with a different lens.
Right.
But largely, at least, it does help the overall sector get some ability to mobilize funds and then scale up and further improve on its stated mission of improving on the financial inclusion.
Since Mr. Srinivasan, since you're an independent analyst, so I want to seek your view on the issue. The MFIN guardrails recently, they have talked about 3 lenders per borrower. I mean, 2-3 years back, when RBI talked about this, they were talking about 2 borrowers two lenders per borrower. So, NBFC MFIs, yes, NBFC MFIs. So what? So MFIN is now talking about 3. So it's a dilution of what RBI proposes. What is the optimal? Do you think?
No, it's really it's very difficult to micromanage a business outside and sort of run. 3 lenders. You need to look at it from just take a step back. Over leveraging has happened in the sector across the NBFC. Nothing only specific to MFI. Let's be clear on that part. So over leveraging has happened on all. Yes, this segment is perceived to be a little bit more vulnerable to economic shocks. So to that extent, maybe the risk gets amplified. Now, how do you see 3 lenders? You have some entities, let's say in the past, 3 lenders or 2 lenders means only NBFC MFI. I'm not bothered about a bank loan. I'm not bothered about a 2-wheeler loan. I'm not looking at a home loan which have been taken by the individual. Then the concept of is it loans at an individual level or at the family level. So if you look at it from those perspectives, to some extent over leverage has happened. Now with the SROs saying that we need to tighten up on that, so that will obviously have some pain. Now somebody who has availed, let's say for an argument, 5 loans from 5 different lending institutions, now suddenly everybody, all the lenders come on the same page and say no more than 3.
Right.
So 2 lenders need to be paid off and the other 3 lenders need to take a call that will I give extra to this person? Somebody may say yes, somebody may say no. So there's a high probability that some of these borrowers may not be in a position to refinance their earlier loans. There would be some stress that would be visible for some period of time.
Right.
From a 3-lender point of view, now that it's really become applicable from 1st April, as you started, possibly the whole crisis, the current crisis started 1.5 years back. So
Right.
hopefully we are at the end of it. And then
I will
most of
come
the
back to that.
problems
I will
already
come
solved.
back to that.
Yeah.
But Mr. Mishra wanted to interject. I understand. Your view, sir, do you think 3 is the optimal level or you should go back to the RBI suggestion of 2?
See, first of all, RBI was 2 NBFC MFIs. So in that regime, when the NBFC was 2, because as I explained earlier, the NBFC MFIs have 35%, 38% market share.
One third,
So if you would go to a borrower, the borrower would have 6 lenders, 2 banks, 1 SFB, 2 NBFCs. So now that all are part of us, we have made it 3 composite.
Okay.
So it can be 3 bank, it can be 3 NBFCs, it can be 2 NBFC MFI, 2 NBFCs. So it is a drastic reduction. And let me, on that point, also give you a data point. Thankfully, last night, CRIF has, the Credit Bureau has given me September data. So the guardrail says that not more than 3 lenders, irrespective of legal type, whether it is bank, SFB or NBFC MFI. Today, 97% of microfinance clients, which are 7.4 crores, have less than 3 lenders, 3 or less lenders. And the portfolio outstanding available with them is 91%.
Right.
And 71% of clients, loan outstanding, microfinance loan outstanding is below 1 lakh. But still we keep talking about over leveraging.
So you're saying the over leverages have come down significantly.
See, as Karthik was explaining, I think probably he did not get to flesh it out. This is the only sector, even if let me take you figure of, again, Credit Bureau's figure of March 2024. So today, as I'm saying, 97% clients are within 3. That time it was 91%. So 8-9% clients were having more than 3 lenders, even at that time, and even in terms of outstanding. So the problem was not that which was made out to be. And the problem in over-lending, which happens, I don't think we have time, but it is not due to the intent of the institution, whether it is bank or this. There are various policy gaps, whether it is the absence of a robust KYC, whether it is the dark side of SHG loans sitting in the loans, whether it is the other NBFC retail loans which are sitting into there. So it is, you give me an example, again, in the interest of time, I will not get into the detail, that any sector of lending 50,000 rupees average ticket size loan, unsecured, has a more robust credit underwriting than MFIs.
Fair enough. Fair enough. Mr. Srinivasan also said that once the company grows, it's natural, the objective will shift, the focus will shift to bottom line. But Mr. Syed, what explained the contraction in the overall NBFC loan portfolio according to you?
I think 2-3 things. One, of course, there is kind of a perceived higher risk and also actual delinquency that is there on the ground, maybe from a macroeconomic reason, certain events like elections or certain events like floods, all of that contribute to it. Because of that, people are a little bit conscious. The second is also a flow of fund. The flow of fund, which was freely coming before, has comparatively reduced. And I'm not talking about my organization alone. Like we have been able to raise funds, that's not a problem. But many of the smaller organizations which were raising fund, they have not been able to get that kind of facility. And it's a kind of a vicious cycle, because if you don't get fund, you don't disburse, the cash flow at the bottom of the pyramid reduces, the customer also doesn't have enough cash flow, so her cash flow gets disturbed. So it has an impact, and when the customer is delinquent, then of course, as per the regulation and as per our own credit underwriting policy, we don't lend to those customers. So that's why I think the business is slightly lesser. People are focusing more on retaining their own good customers and ensuring that the portfolio that they are managing remains stable. So that's why the growth is not there. Unfortunately or fortunately, the microfinance portfolio itself is designed in such a manner, it runs off very fast. So it's a 2-year loan, mostly weekly or maybe monthly, and it's a fast repayment, so it runs off fast. So that's why you would see that there is not much of growth in the AUM. And there is kind of a good, like lesser disbursement as compared to earlier. But I think I was overhearing your conversation, of course, previous like 2-lender or 3-lender thing. I think we need to put this in right context. Microfinance gets blamed unnecessarily. We were in my financial inclusion space. We were the people who got these customers into the formal sector. So whether microfinance are responsible for overlending or somebody else is eating my cake, that is what we need to evaluate. Like if there are 3 lenders, who's the 3rd lender, who's the 4th lender, who's the 5th lender? We need to evaluate that. I think just blaming microfinance institution.
I will come to that. I will come to that.
I think that's important to understand. And also, I think one thing also we need to understand, just because like it's a kind of a prevention tool that MFIN put in, that okay, not more than 3 lender. But if you look at analytically, 2 lender does not mean that customer is less leveraged. 3 lender does not mean it's over leveraged. It's relative to the income of the borrower. If the borrower's income supports, then he is sufficiently leveraged. If it does not support, even with one loan, he is over leveraged. So it's 2-3 is just a surrogate norm. The right thing that RBI has done is to put a FOIR concept. There is a fixed obligation to income ratio. So if you have a certain income, the FOIR should not be more than 50%. And if anybody is lending more than 50%, that is over leveraging.
Right, right. Mr. Singh, what explains the fall in the portfolio size of the microfinance sector?
See, I think it's a combination of a lot of factors, and not just can be looked at just purely one. See, after everything, whenever there's a kind of a crisis and everything, I think, the first thing which happens is the liquidity starts drying up,
Right.
And that's a very, very big Ms. Norman, in terms of, how you're viewing the sector as such, And suddenly you find, the lenders developing cold feet of not lending, Now, for us, the raw material is only this. There's nothing else, we can do. We don't have the liberty to do, deposits or anything, See, look at, how SFBs and the banks are placed right now. Since they have an option, everybody started reducing the microfinance portfolio. We don't have an option. Our option is only limited to the factor that for us, as long as we start getting raw material for us, we'll be able to lend. And I always feel, that's probably, I think, Mr. Mishra is going to hate me after this, because he has associate members who are banks and all. I think this was a sector which was specifically targeted towards NBFC MFI. The moment you have a lot of other players jumping in that, I think, now they're on the same page as what we are. But I think, before that was like, today banks have the liberty to actually take a customer into some other fold if it's an existing customer. We don't have that liberty. Today, if my existing customer who's paid good, who's absolutely fine, the moment he gets out of that FOIR norm, the moment he gets into any kind of a tangle, I can't do anything about it. For me, it's a non-qualifying asset. Now, that's probably a big factor which probably there's
Sorry, I didn't get you, I think. Are you indicating that only NBFC MFI should be present in the sector?
We're not saying that, but ultimately it should be restricted the way it was restrictive towards us. Now, I think it's on the same page, but the idea is we don't have an option for us. It's a qualifying, non-qualifying, the criteria of 60%, everything, We've got that. Nobody else has that,
Right.
So once that level playing field becomes a little uncomfortable, I think, the growth will always take a beating,
Right, I understand. Mr. Srinivasan, why do you think banks are developing a cold feet, as Mr. Singh was saying, to lend to the MFI sector?
As Mr. Singh said, NBFC MFI, to put it very simply, it's a single product company. That is what you've given a license to do. If you look at a bank is a multi-product entity. They have the flexibility to move from corporate to retail to infrastructure to agri, whatever they want to do, depending on the flavor of the season, depending on their risk appetite, they can take that call. Today, they are saying that there is a stress in this portfolio. So let me just be a bit more cautious. Let me hold my horses for a couple of quarters. And they're slowing down on the disbursements on that side. And again, this particular asset class is a short tenor asset class. What couple of years back was only 1 year, now on an average is about 18 months to 24 months kind of an asset class. So even if you don't do anything, the asset runs down very fast.
Right, that point has been made.
When they are growing, and today the growth for the banking sector is coming from home loans and other retail loans, and those are really long tenor assets. So when you look at a proportion basis, the proportion of MFI on the books of bank, that proportion starts coming down. Right. So maybe once the sector sort of stabilizes or revives later part of this year, you'll probably see banks come back into the sector as it's a good, a risk-adjusted return that they're getting from the portfolio.
Right, it's a profitable portfolio, so they cannot completely wish away. So we come back to the main question that we are asking Mr. Mishra. When do you think with the end of the cycle now, the worst is over, or there is a few more quarters to go?
See, worst, it is a relative concept. There are two parts to it. Somebody will look at portfolio at risk 180 days and beyond. Somebody will look at 1 to 60. Somebody will look at 1 to 90. So one is 180 plus is the impact of past. So that figure, I will focus on 1 to 90 days and average delinquency in month on business. If loan is seasoned for 3 months, 4 months, 5 months. So that is clearly coming down. And if the disbursements would have been normal disbursement, I would say in a quarter, around 80,000 crores, which have come down to 60,000, 57,000 crores.
Quarterly disbursement.
So that's why, because of the denominator impact, it is still looking high. But if it would have remained at that level, it would be normal. So in short term, the new business which is being written is returned to normal, but the long-term impact will be there. However, because as the other practitioners were telling, the NBFC MFIs primarily dependence on bank funds, 75 to 80% on the sector as a whole. Large institutions may have diversified sources. Liquidity is the key right now. If liquidity doesn't step in, the momentum which has been gained can be frittered away. So I hope the liquidity steps in. We are talking to the government about the guarantee scheme.
Yes.
If that gets in, I think as far as new portfolio is concerned, worst is over.
Can you explain in a bit that what are your asks to the government, to the audience? What exactly you are asking for the government, if you can explain to the audience?
See, what we are asking is like in COVID, in 2021, the banks again went into a sell in lending to the NBFC, and there was, you will remember, there was a double whammy on NBFC MFI. That on loans collection from borrowers, we had to put moratorium, but on repayment to lenders, there was no moratorium.
The entire NBFC sector faced that problem.
The problem. So the government came up, Department of Financial Services, with a 7,500 crore guarantee scheme that to give confidence to banks that if you lend to these players, in case of default, government will, major part of it will cover.
Yeah.
And to the credit of the sector, even from that COVID time, not a single money was defaulted, and the banks got all back the money, so there was no fiscal impact. So we said to the government, now the situation is much better. If you can institute a larger guarantee fund, say 20,000 crores, which will kickstart the virtuous cycle of funding, give confidence to the bank, and there is no fiscal impact also, because hardly there will be any default, so your money will also come back. So that will start the virtuous cycle.
Right.
So that is under active consideration. We hope that can be expedited, and then if that happens, then things will get back to normal. It is already
Great.
normal, the momentum will be sustained.
What has been your experience? When do you think the cycle will turn?
So, Manoj, I think we are already witnessing a turn of the cycle. I think, as we explained, the whole episode was linked to the macroeconomic situation and certain events. If we look at currently, I think the inflation has gone down. The crop has been really good. The rains have been really good. So because of those good crops, the vegetable prices have also gone down, because of which the affordability of the rural household has improved. And as the disbursement also improves, and as Alok sir is saying that liquidity is infused from RBI and the banks lend, more and more cash flow improves at the bottom of the pyramid, definitely I think the collections will also improve. Personally, we are witnessing better collections. We are witnessing better disbursements. So the trend is towards the positive. The only thing is that earlier crises have been slightly shorter, 6 month or a 3 quarter, but this has been a little bit prolonged because there are multiple events which have happened. But otherwise, we are witnessing much better disbursement, much better collection, and also we are witnessing a better portfolio which we have disbursed after the guardrail. So that is definitely helping us to recover faster.
Right. Mr. Singh, the guardrail helped in stabilizing the asset quality?
See, for us, I think we were a little different. We brought in our guardrails, maybe 2 years back.
Okay.
I think that's why our portfolio quality was practically under check, and that's probably evident on record, But having said that, I think, we've also enumerated during this period of time in our earnings call and everything, we are in fact opening 400 branches now. Now, when we say 400 branches opening at this particular juncture means that the things have come back to normal, means that the growth is coming back, means that whatever was happening because of guardrails being put in, because of all these factors being there, Mr. Mishra talked about the credit guarantee scheme and everything, we're hopeful that we'll get it. I think, for us, it's the mindset, which has to probably change, That mindset is probably undertaken, we've taken that leap forward, that since everything is coming back into shape, the PAR 1 to 180 has gone down significantly. If you look at Q1 and Q2, in fact, there's a difference of about 2% between these two quarters as such. So if these shoots are coming in, if these things are coming in, I think it's only a matter of time before we finally be able to see the not the kind of unprecedented growth which we've seen earlier, but I think the kind of robust growth which probably will be there, and it's going to happen.
Mr. Srinivasan, the industry players are saying that the worst is over and the cycle has turned. Does your number crunching shows that?
We do believe worst is over, but are we going to come back anyway close to the highs that the industry saw a few years back? I think that is some time away. You know, we have seen a degrowth in the industry AUM June over March. Our estimate basis, couple of numbers which have come, maybe September, maybe further down. I really don't have the data, but in all likelihood, the September AUM could be slightly down than the June numbers. So with 6 months having gone, to in all likelihood, a growth in AUM for the current year will possibly only be in single digits. With credit cost coming down going forward, maybe last year the industry reported net losses. This year, our estimate is maybe 1% ROA, somewhere in that vicinity is where you could see the industry. Maybe next year it'll go up to 150, 160. You know, but 2 years back, 2023, 2024, we saw ROAs of closer to 4%. I think that is some time away.
Yeah. So, Mr. Mishra, you're saying that asset quality is improving. The next is when the industry come back to growth. So, what do you see?
See, in growth also, as Karthik was saying, that while others have also said that the portfolio have degrown, because we reached 4,33,000 crores in March 24, and he was telling about September. The September figure is 3,40,000. So there is a degrowth of 21%. But what has become nuanced in that, that if you look at maybe Muthoot or Satin, you have to look individually. Maybe their growth momentum has not, or their portfolio has not dipped, or credit access, they continue. In between, middle players have sunk. Some have gone down by 60%. So when you talk about these overall numbers, this is industry as a whole. That is like taking the height of person sitting in the room. But somebody might be, Mr. Singh might be 6'4". So you just can't say that everybody is of that. So that problem, it has become accentuated in this downturn cycle. So your question was, do you think the asset, the AUM keep growing up? I think the individual differences will accentuate unless liquidity comes in. If liquidity comes in, we will again come back to a stage of where the rising tide is lifting all boats.
So in that context, the guarantee is also important.
Yes.
I have one question from two microfinance institutions who are there. What is the road ahead of the MFIs? Do you think converting to a small finance bank is an option which you consider seriously?
As a institution, we can firmly say that we are not in the race for becoming a small finance bank. I think we know that this is the business that we know better. And RBI has recently kind of liberalized in terms of qualifying asset criteria. It was 75-25 earlier, now it is 60-40. So you have more room to innovate and do more businesses. So we have recently launched individual loans for our customers, and it's doing well. So we will innovate within that space, might not dabble into SFB business. It's a different ball game altogether. And we are seeing things improving, growth is back, credit cost is going down. So I think you don't change your business over 1 year or 2 year issues. Yeah.
Mr. Singh, I was asking this question because RBI has showed huge confidence on the microfinance institutions, which is they have allowed MFI to become a universal bank. They have allowed several MFIs to become SFBs. So from that point of view, do you think conversion, transition to the SFB is an option?
We are very happy doing what we want to do, and I think we love that, And honestly, for us, I think, you don't want to put more pressure on us, by converting again into an SFB and then get into the ball game of liabilities and all that stuff, That's not what we've been made for, That's one. The other factor, we as an institution, we've got 2 subsidiaries of ours which does MSME lending and housing finance. So we've got options to do that. And as what Sadaf said, definitely yes, by the qualifying and non-qualifying norms being coming down a bit, I think we've got more options to do that.
Diversification.
But having said that, I think, one thing which I would probably put it across, and I think, I hope, we all agree on to that, but I think we are best suited to do microfinance, We've done it for our lives, We know what to do in it, We've in fact done what possibly has not been done by anyone, I think if you talk about financial inclusion, not just speaking on the stage, we have actually done it.
Right.
If you look at if you look at our borrowers, definitely, as you can talk about, negative connotation always is the best connotation which people love to hear about, But I think, if you look at the positivity, employment in terms of rural employment, we've got a huge field force. We've got borrowers, who possibly would have never ever dreamt of getting, this kind of a money at this kind of an interest rate, So
Right.
I think, let's gloat over the positive which have happened rather than, spending a lot of our time talking about negatives, because negatives don't give you anything,
Right. We have completed a lot of time, but I will take a couple of questions from the audience. Yes, ma'am, if you can.
Sir, is the direct...
Can you please identify yourself?
Yeah, I'm Nidhi Singhania. Is the direct benefit transfer money that the borrower receives having an impact on the repayment capability, like you consider that under cash flows while assessing?
Mr. Singh, yeah.
Because direct benefit transfers are the huge...
See, for us, our cash flows are based on the business which they do, So it is all related to the business which they operate in. So for us, I think, we don't take into consideration when we do a cash flow analysis, whatever informal way we do a cash flow analysis, direct benefit transfers normally do not get into that kind of a, for us, the calculation is over there. So for us, that's whatever bonus is there for the borrower, for them to enjoy whatever they have to.
Sir, but is the, like some states, asset quality, MFI asset quality got impacted because of the delay or non-receipt of DBT payments?
No, it's not because of that. It's not because of that.
Anyone else? You can pass on the mics. This side maybe. Yeah, please identify yourself.
Hi, my name is Raghav and I have a question for the entire panel. So I'm working
Yes,
for Simbo Insurance. Okay. I'm working for an insurtech company called Simbo. And related with insurance, there's been an emerging trend where a lot of insurtechs like us are chasing NBFCs and MFIs, and I believe Saturn is working with CoverFox as well. So how do you see that entire process of attaching insurance with loans unfolding in the future to protect the credit risk of the MFI NBFC as well as add to the PNL?
You want to answer? Yeah.
Yeah, sure. So as the microfinance industry is focusing on financial inclusion, and financial inclusion does not only mean giving one credit kind of facility. Financial inclusion means credit, saving, insurance, remittance, and financial literacy, and increasingly even digital literacy. So I think insurance is a part of the larger financial inclusion theme. But being a kind of a lender to the last mile, we are more conscious about that we are offering the product to the customer which suits their needs. So for example, if it's a natural calamity insurance, it works well for the customer because she is protecting her asset, her cash flows. If it's some sort of a credit shield, credit life insurance, that protects her. So suitable products, yes, of course. I think those are the products that we are offering to our customers.
Thank you so much. I think we have come to the end of this panel discussion. The message is clear. They are coming out of the woods. There's still some way to go, isn't it? And on that note, please a big round of applause to all the panelists. Thank you so much.
Thank you very much. When we had started this panel discussion, we started on a somber note in terms of the questions also, in terms of the number of people we had in the hall as well. But it's, progressed on a very positive note, and the vote of confidence and the conviction in the sector. So thank you very much. Do stay on the stage. We have some mementos. Actually, one picture, Manojit, with you in the frame. Thank you very much, everybody. Thank you for being here. We'll break for high tea, but please be back again at 5:35 over here. We have a panel discussion on Bima Sugam. Could it be like a UPI moment for insurance? But before that, at level 3, there is a conversation with Mr. Lalit Kashre, CEO of Grow. That's from 5 to 5:30. 5:35 is here. So thank you very much. Do also take this opportunity to go around the exhibition area. There are a lot of like wonderful stalls, and some of them have really great immersive experience as well. Ladies and gentlemen, we will just begin shortly. Our panelists are at the venue. They are just heading to the hall. Snacks. Yeah, Vishal. Thank you for your patience. We have our panelists are here. And do please take your seats. And our experience is that the hall fills up quite quickly as the panel discussion starts. So the conversation is about, can Bima Sugam be a game changer? Now, Bima Sugam is being positioned as a potentially transformative platform for India's insurance ecosystem, a unified digital marketplace where customers can compare, purchase, renew, and manage claims, and also store their policies in a digital locker-style repository. The vision is ambitious: to make insurance as accessible and frictionless as digital payments, thereby broadening penetration, which is currently low in India, and reducing distribution cost. The question is, can Bima Sugam indeed become a UPI moment for insurance? May I please invite on stage our moderator, Business Standard Assistant Editor, Mr. Subrata Pando. And our esteemed panelists, we have with us Mr. Debashish Banerjee, Partner and Insurance Sector Leader for Deloitte South Asia. He has more than 20 years of experience in delivering projects, building talent and business development in advanced analytics, artificial intelligence, machine learning, and predictive modeling. We also have with us Mr. Narendra Parindwal, who is the President of the Insurance Brokers Association of India and has over 20 years of experience. He is also Principal Officer in RMS ARC Insurance Brokers, where he implements client solutions and oversees regulatory engagement. We have with us Mr. Sharad Mathur, He's the Managing Director and Chief Executive Officer of Universal Shampoo Insurance General Insurance. He has 25 years of experience, over 25 years of experience in corporate development strategy, primarily in non-life insurance. We also have with us Mr. Amit Roy. He's the partner and leader of insurance in allied businesses at PwC India. He leads the company's domestic insurance sector practice. Over to you, Subrat.
So it's a good crowd for the time that we are in. So the panel is about Bima Sugam, something that has not been launched yet. But I'll just give you a brief idea about what Bima Sugam is before I dive into the questions to my panelists. So Bima Sugam is a regulator-enabled, industry-led and technology-driven insurance marketplace envisioned to transform the insurance ecosystem in India. It will offer a single window platform for policy purchase, services, claims and grievance redressal for all stakeholders, including consumers, insurers, intermediaries and agents. It is essentially the UPI movement for insurance sector, a phrase coined by Mr. Panda, not me of course, the previous chairman of IRDI. Essentially it will be like an Amazon-like marketplace for all things insurance. And in this context, we are going to discuss on, can Bima Sugam be a game changer? And my question to all four of you is, can it actually be? If you can, Mr. Roy can start.
To start with that, thanks for picking up a topic which is very contextual. I think last about 6 months, it was a little dull about Bima Sugam. We had a lot of noise, positive, negative, both about Bima Sugam. And last 6 months had been quite on the front of Bima Sugam. So happy that, Business Standard picked up something which is very contextual to my movement. And is this going to be a game changer? Well, I am an incorrigible optimist on anything to do with insurance. I think insurance is a matter of creating more, the challenge is about creating trust in the mind of people more than anything else. I think people do humongous amount of research and effort in terms of finding out what is the right product. Personally, I feel more than that, it's all about creating trust, giving people that opportunity to create something for herself or himself. I am looking at Bima Sugam for answers to that. It will create transparency, it will create visibility, it will allow people to customize things, and most importantly, it will put immense amount of glamour and pride to the industry, which this industry badly needs. I was talking to a group of people this morning who are investors from different geography, and they were inquiring about agency as a channel. And people get shocked that such a large country, the number of agent, industry all put together, life and GI side is minuscule. About 2.5 million agents, and that too they do not work. And primarily it's all about creating a pride. You see that 2 million children, become engineers every year. And last about 50 years, the number of agents is only 2.3 million. So I think that's what Bima Sugam should be changing. So those are the initial thoughts from my side.
Mr. Mathur, given you have invested in Bima Sugam, if you can give your perspective as to how do you see this product or this initiative by the regulator, and what will it transform? How will it transform the insurance sector?
Yeah, thanks. So, as an investor, if you're asking, my views would be very biased. So I would be happy commenting as a beneficiary more, of course, as part of the insurance fraternity. I see that in our country, as Amit has also mentioned, penetration has been abysmally low. Penetration, whether in terms of population base, 1.45 billion population, if you see health insurance, which creates social security, we are still hovering at about 35–40% max. And in other markets, other countries, I'm just citing an example, Vietnam, which is not so matured like the US and so on, 70–80% people have insurance with them. Maybe size matters, it's a tiny population base, easy to cover. Here, if number of insurance agents are still hovering at about 2.3, 2.5 million, so it becomes necessity for us, because which is a clear reflection that brick and mortar offices or physical presence, representation of insurers or distribution fraternity distributors ranging from our broking partners to agents, POSPs, automobile dealers, we are still not able to go so much beyond metros, mini metros, state capitals, to the core India, which is rural pockets, tier 3, tier 4 locations. So the whole idea of Bima Sugam is to increase penetration of insurance on population-based dwellings in those pockets where representation of insurance fraternity, insurers through their offices, through their distribution partners, through their branches and so on, is not so easily available and is difficult to set up brick and mortar offices there. So accessibility is one thing which will going to change with the invent of Bima Sugam. Second issue in our country is affordability, because as we go into interiors, insurance premium affordability or whether to buy insurance or not is a big question, because they have so many other needs, basis, whatever disposable income they have. So insurance affordability, where one move, positive one, has been already introduced by our government, very kind of them to consider removing GST from life, health insurance, travel, accidental covers. I think with Bima Sugam, one thing which will get which would going to support the affordability is that the idea is from sales to make it an advisory based distribution. So it is not going to disintermediate. So our agents, distributors will remain. They will also be partnered with Bima Sugam, and from commission, which is ranging at about say 20 to 30% currently, would get converted into a fee for them. So to that extent, premiums are likely to come down. So one GST 18% reduction already happened. The moment Bima Sugam launches, we hope that about 20% in addition would further come down. So which will make it affordable highly in those pockets, even in metros. So I think these things would going to bring a big positive change and will be embraced by entire population range.
Mr. Barindwal, I mean, on the distribution part, if you can throw some light how that's going to change with Bima Sugam coming on.
See, if we see Bima Sugam as the next step of the digital journey of the Indian insurance industry, and if it makes life easier for the insurance policy holder, both on the purchase as well as the claims side, then it's a welcome move and everything. But during the course of these discussions and everything, if you see how the insurance industry has evolved over the last 2.5 decades, post-privatization, everything, regulator, all the insurance companies have brought in reforms, made changes to regulations, brought in various channels of intermediation. Brokers came into India after privatization. Corporate agency came into play. Point of sales persons have come into play. MISP is there. So this entire ecosystem, which has been created by the insurance industry, and the government thought appropriate to bring in 100% FDI first in insurance intermediation, then increasing FDI in insurance companies. So considering all these factors, the industry and the regulator and government of India has created a huge distribution architecture. Almost, if my numbers can be debated, 4 to 4.5 million people are directly and indirectly employed in this distribution thing, bulk of them on variable pay basis. So currently we are unclear about how this will get integrated in the Bima Sugam jigsaw puzzle. So we look forward to guidance from the Bima Sugam Federation board also on how we can have a conversation and do things. Secondly, we need to understand, of course, UPI is a great success story for India, and government of India is talking about UPI in various geographies and is being used for transacting payment. Fundamentally, UPI is doing something and insurance is something else. We are still a push product. We are not a pull product. A lot of advisory is required when you buy the product. You take today the health insurance landscape of India. There are, I cannot count how many, maybe more than
500 different types of health insurance policies are available in the distribution ecosystem. How is it going to be possible to compare the features of all products and whether there will be ease of buying by the policyholder? So there are so many things that needs to be told. So advice is what people look when they're buying insurance for. And that's exactly where the role of intermediary, whether it's a broker or the agent or the corporate agent comes into play. So definitely, as I said, if this is a journey to ease the buying process, ease claims, it's a welcome move. We will also embrace it and try to find our participation in that. Currently, we look forward to guidance from the Bima Sugam Federation, how they are going to accommodate us.
Mr. Banerjee, on the distribution part, I would want you to throw some more light. Do you think the distributors should be wary of this platform or wary of this initiative by the regulator?
Sitting next to Narendra, it's difficult.
That's why I asked you, because you give independent views.
Right? No, it is difficult. No, so first of all, like Amit said, it's a great topic, and thank you for picking it up. Coming in last is always difficult. A lot of has been spoken about, but quickly, if I can highlight a couple of things that sort of comes to my mind with that initial sort of question that you asked about whether this is the UPI moment or not, and I think Narendra touched a little bit on that. But just to amplify that piece, yes, it is the UPI moment, and if you ask me, can it be a game changer? Absolutely yes. I'll give a consulting answer. Absolutely yes, if done right, right? And the biggest challenge is going to be, are we doing it right or not, right? So just a couple of things. For example, Narendra just highlighted. I will give a little bit of a different connotation of the similar thing around the distribution piece. See, in UPI, it was taking care of transactions. What we were trying to replace? We were trying to replace the Visas and the MasterCards and the Amex of the world. Correct? There was nothing else. So this was a great initiative. India played a big role. Now we are up there. Everybody's taking a notice on that. However, like Narendra was mentioning, here it is an ecosystem that is already established. What are we trying to change? Are we trying to change the brokers? Are we trying to change the agents? Are we trying to change? What are we trying to change? There are aggregators already, for example. So that piece has to be really thought about and dealt with very, very well. And I will just take another piece that Sarad mentioned, very, very well said, which is, will the business model change then? Will the commission move to something else? And will that be beneficial for the policyholders? And absolutely yes. If those things can be thought about, that's a very good place to start. And therefore, my view was, see, ultimately, if we are trying to build some kind of an aggregator and the ultimate vision is insurance for all by 2047, two comments I want to make on that. One, are we just creating another aggregator and just change the commission to fees model, the business model, and is that the innovation? Then that's one thing. That will not help solve the final objective that we are talking about, which is under-penetrated and not penetrated areas, right? And I know it will always be rolled out in a phased manner on all that. The piece that I have in mind is that the phase should not be line of business or health first and motor second and all that. In my mind, if you really want to do this right, the phase should be based on geography. Under-penetrated first. That way, then none of the ecosystem is getting impacted. You are creating a very different platform to start with. Right? You start with the rural side of things. And I know it's difficult. I know that's going to be, is not, easy path it's not an easy path for sure. But something like that, if we are thinking, and then bringing up the thing, that gets a little bit of time from the distribution, existing ecosystem and all that to also adapt. The business model changes, the fees comes down, policyholder gets benefited, and all of a sudden all of this sort of triggers one thing over another and so on and so forth. And the second piece, and I was just telling this before we came here, I will end with that this should be a government initiative in a manner, funded by industry or whatever, who owns it is a question, of course, but it's funded by this thing. So one piece that I always speak about, see, India as a market, insurance market is slightly different. And we spoke about penetration numbers and ratios and things like that. We are far below the global averages. But we need to understand the definition is GDP. And if GDP is the definition, the way India's GDP is growing, that's unparalleled. And we have not seen that across the world. For stable markets, this kind of a definition is great to have. But does India have this UPI movement to change that definition of penetration? And if you're talking about population, should a penetration be defined on number of people insured? And for India, does that make sense? I don't know. But if this is a government initiative, that can be achieved very easily in my mind. Because then you have the Aadhaar numbers, you have the citizen thing, you know exactly how many are insured. You can think on those lines. So my only comment is, can this be a UPI movement? Absolutely yes. Should we think of these uncharted territories to make that happen? Maybe that's the way to go.
Right. I think one of the panelists mentioned that aggregators. Will the aggregator business model be under threat now, given if once it's launched full-fledged? Because it, in a sense, going to do the aggregator business only. Mr. Roy?
So, it's almost like looking at future.
Of course.
But honestly, I think a couple of things, I feel very confident that will change. And the trust in the business will change a lot, right? Because somewhere I still feel insurance is a very complex technical product. And a bit of intermediation is required, if not a lot, to put out, transparency into the entire conversation. Now, how do I make believe my customer that whatever as a distributor I am saying is right and is credible? I think Bima Sugam could be a very good support on that, right? I am extremely confident about that distributor fraternity will support Bima Sugam more than anything else. And because this is unbiased and this is something which is industry across is investor, this is something which is an initiative from the government aspect. The credibility from D1 would be higher than whatever we have seen. If you see the overall ecosystem wise, I think we are at a tipping moment. The ability to have connectivity to the last mile of this country is there. We have excellent network in terms of banking aspect of the poorest of the poor, thanks to Manrega and all those government schemes which are there. If you see in terms of creating an ecosystem through integration of, let's say, a national digital health, let's say a Aadhaar, let's say a biometric identification and all of that. Now the challenge lies is, how do I simplify everything? So I expect Bima Sugam to create something which is, sorry for taking that simile, is like Maggi, Maggi noodles, when it started, it was something like a connoisseur's choice. But it spreaded across the country. And in the remotest of the village, you find that in the thela that Maggi is available and at a very affordable cost. I think these two things, go hand in hand. Is that if it is simple, if it is affordable and transparent, the credibility automatically goes up. So there, I believe, more than the business model, the belief on the system will actually take its own course. And I do not know what will be the business model and how will it look like, how much of profit margin, too early to say that. But I am saying that along with that, if the cost of running my business go down, like Sharad was saying, I think industry will be a lot more happier, right? Because today, your biggest problem is minutest of the thing like a KYC AML. Now, for Bima Sugam, do you expect people to do another KYC AML? I mean, then it is a showstopper. And then you are hitting the roadblock. I think those are the finer things that we need to solve.
The other thing is, the idea perhaps was floated in 2022. And till now, we have just seen a website and few board members are there. The CEO has been appointed and few CXOs have been appointed. Now, the broad question is, when do we see this fructifying? When do we see this idea turn into reality? Mr. Mathur, if you can touch upon that.
So, it is in a very advanced stage, just to share with you board members comprising of regulatory body members, officials, so to say, industry people, and also the management team, core team members, technology person besides CEO, finance, risk, already are in place. ISO guidelines alignment, so because data privacy would be of high relevance here. Entire financial data would be available, so it needs to be very finely shielded platform. And overall, why it is taking a little more time than expected? Because we have been thinking that it is another digital marketplace. So it is not about technology, it is transformation which is happening. Because the colossal size of our country or population base, we just can't have any additional marketplace and assume that entire country will now start buying on this portal. So when transformation happens, it takes a little time. But to answer your question, it will going to be launched in a phased manner, like lines of business or geographies and so on. Very soon, probably early next fiscal, we are hoping that we should be able to roll out in some way. Website is almost getting developed. It has been launched very recently, about a month back, in RDI office in presence of all members there. One big thing that I see to address your earlier question, that whether it will be a threat to other web aggregators. So it will not be a threat to any web aggregator. They have been there since decades and they have their own marketplace, own set of customers. Their model is very different. Here the idea is to have inclusion of population which is left out in the whole process of the way web aggregators have been functioning. So they would continue to function and this would operate very differently. So here it is customers, besides getting access, they would be able to not only draw comparison with features of various products of all sort of insurers, would be able to buy post comparisons. Then they would be able to maintain their policy in terms of DigiLocker facility, as was announced in the beginning of the program. They would also be able to make a claim, so reporting of claim, and to see the various stages of claims till it is finally settled. So it is like end-to-end management of insurance policies from buying to claim settlement. So it would make the whole Bima Sugam a little advanced in comparison with any other marketplace which is currently available. So it's like Amazon, and besides Amazon, we have so many other such marketplaces offering same sort of products and services. And when I say that it would be assisted sales, so it would be integrated with the broking entities. Many agents, POSPs were asking these questions. Now they are comfortable. Just to elaborate on my earlier point, it is not going to do any disintermediation. All distribution partners would be able to come and do selling if any customer is not so tech savvy to carry out a transaction or fearing to carry out a transaction, but using data and is only comfortable drawing comparisons and then figuring out that I want to buy this policy probably from these 2-3 insurers, but how to buy and so on. So, and any additional information. So then agents would be there to facilitate. So this is where I'm saying that selling will become more advisory, because my dear friend and we were once discussing that, it is about risk-based advisory more than simple buy this policy, pay premium and commission felicitation by the insurer. So it will just going to elevate each element of insurance the way it has been happening currently, besides focusing on insurance inclusion and enhancing social security net.
Thank you. Mr. Barendwal, I just want to touch upon the commissions part. I think Mr. Roy mentioned that it can move from a commission-based structure to a fee-based structure. Will that be something that the distributor will be comfortable with?
lot of discussion is going around this. I mean, earlier sessions also there were panelists who touched based on commissions thing.
I think the regulator also spoke about that today.
So we need to understand that when the industry has created such a huge distribution and intermediation infrastructure architecture, we are here because the insurance companies support us and we are providing solution to the policyholder. So one fact that cannot be taken away, I mean, that can be taken away from this is that this kind of risk and capital, insurance companies are unable to take. They are not able to invest their own capital in creating. Hence, we have the variable pay model, and we are rewarded or paid only when we convert, solicit and convert business. So now, how much is right? How much is appropriate? That I think the regulator has moved away from capped commission structure to EOM structure and left the marketplace to decide about it. So I think we should let the marketplace decide about it and not discuss this more in thing, you know, actually speaking. And then, having said that, of course, the penetration of insurance is low. Government is concerned, regulator is concerned. We are also concerned. We also want penetration to increase. Now, we don't have one size fits all product over here. We have got silos of population. A, who can afford, who can buy incremental insurance, A, who cannot afford itself, and who depend upon government programs, subsidies, and everything and all that. And then this GST reform that has come now, which is genuinely a good thing, especially on the health and life insurance side. So we need to put our efforts together to ensure that we reach out more, reach out to the uninsured population, and the existing insured population, if we can make them buy incremental insurance cover. These two things needs to be looked into. And there's a cost involved for it. Technology is a cost. The fact that, which if I'm not wrong, when the discussions around Bima Sugam Capital started, it was around 50 crore rupees in the beginning, and then it went up to 500 crores. And they have got some commitments from the both LI and GI council players in it. So that itself shows that they are also investing so much capital in building this entire infrastructure. So there is cost involved in everything. So we'll have to look at it from that perspective, whether it's a web aggregator, broker, agent, there's cost involved. Today, after the GST reforms have come, we have got various distribution and agency bodies writing to the PMO, FMO, IRDA chairman on the transfer of GST burden on their commissions. And a rural agent, a POSP who's working on the tier 2, tier 3, or the rural at the panchayat level, taluk level, he feels the pinch for it. And many of them look at insurance agency or intermediation as their livelihood. So a variable pay livelihood insurance distribution provides. So these are the facts. So we should see this in right context. Just only talking about commissions is unfair to us, I guess. Yeah.
Understand. Mr. Banerjee, I'll put you in a bit of trouble. Since you said this is a government, not, I won't say backed, but probably government initiative, but we don't see the PSU insurers being involved in this. How do you read that situation?
That is putting on spot. I think there have been discussions on some conflict of interest kind of discussion that has been there. I do know PSUs had the interest as well, and it just for some reasons that it has been stuck right now. So again, like Amit said, it's a crystal ball. We don't know where it'll end up in. But nevertheless, I mean, industry is backing it up, whether it is PSU or otherwise, it is backing. And like a transfer, like Sharad said, it's a transformation, so it'll take some time before we really are able to understand what shape and form it ultimately takes, right? Any of the transformation does take some time, and we have to give that genuine time. Otherwise, it is too soon. So with that thing in mind, but for sure, business models will change. For sure, all of this is going to shape up in a manner that the industry is absolutely looking forward to. There's a lot of interest. The world is looking on to India. And I mean, when I talk to all the MNCs and friends outside India, they are looking up to India as a big, marketplace, and clearly how do we improve the penetration, especially as we become the fourth largest economy and go further up into the top 3 race. This is a backbone in any of the matured economies. And we have to get there. In what shape and form and what role will Bima Sugam play is obviously the question mark.
Thank you so much. My next question is, will companies now come out with differentiated products for this marketplace? Will there be change in the product mix, product portfolios? Anybody can answer this time. Mr. Mathur, I would, if you can.
Yeah, of course. See, when we talk about reaching out to masses, we can't have same motor or health kind of umbrella products. Say, for example, already quite a few insurers have started working on product development, innovation, ideation. Say, we would have heard products like hospital cash under health insurance, various critical illnesses, which are very historic products now. But some innovative variants could be, say, heart ailment, for example. So we broadly know that there is heart surgery, then stents, and there are so many other, which probably even sitting here I do not know, not so handy with me. So developing a product for those coverages, for each organ, and again getting deeper into, say, surgical procedures for something is very high as compared to maybe, say, knee replacement, for example. So creating product only for that thing. And we are doing a little research that what kind of customers, is it age group or the lifestyle or the way they have been consuming food, other adulterated liquids. So is that a differentiator? So if that is so, then reaching out to those people with some kind of a prompt that if you are in this age group, you probably would be doing this. If you're doing this, you are prone to this. And for this, you should consider having this coverage. So entire thing will change. Today, our advisors, whether agents in form of POSPs or brokers, they are very responsible and highly accountable of advices they make. But the kind of products which are currently being made available by insurers are mostly products which are similar to each other. We do not see much differentiation. And if any product is launched, it is just launched because to have something being offered as a different product, just to create that differentiation, but not actually matching requirements of the customers. Many customers do not know that they require this variant of this product because they do not prefer insurance as a commodity to buy. But making them aware, relating it with their vulnerability going to make a difference. Then it will become easy for insurers to create more such variants, and it would be a consumer pull market more than pushing, because currently also insurance is being pushed, whether it is motor insurance, which is mandatory by law, or health, where awareness has been created more by recent COVID. Other products where financial obligation is. So it is more bought only when it is an obligation or law is making it mandatory. But to make it pull, it is necessary for insurers to enable customers, one, to have access easily, and then second, to relate it with their vulnerable situations. I think that will going to stitch and will enhance penetration. Whether someone doesn't want to buy full health insurance, but then I know that I am vulnerable to this because of my maybe lifestyle, my age group, or my hereditary thing, and I'll then buy only this much. Pricing is low because cover is only limited, specifically made for me. I'll feel and I'll easily buy. So I do not need anyone to come and impose that product on me. So these are some of the things which will going to be different as Bima Sugam gets fully rolled out.
Mr. Joy, if you can add, yes.
A couple of things to what Sharad said. The expectation from Bima Sugam would actually evolve. That's what is with the journey, you know. Two good things are happening for the industry. One is I keep tracking the entry age, you know, at what age people are entering. Good news is that last about 10 years statistics tell me that India is moving towards reducing that entry age both on the life and the health side. Not so much on the PNC side, unfortunately. But health is now, interestingly, looking at 37 as age at entry at an average. Life is still younger, 32. That shows that young people who would like to be empowered, you know, they are looking at insurance and they would like to be deciding, customizing their own product. And Bima Sugam actually can give a subway moment along with the UPI moment to customers to decide on what are the coverages that I would like to have. And possibly there the manufacturer can give an opportunity to people in terms of deciding how much you want for how much of time and at what cost. So customer in the way of getting empowered probably will be more informed and more responsible. And somewhere the industry might change course on that. And that transparency can actually make it more easier for the distributor fraternity also. That's what I believe.
Mr. Banerjee, if you'd like to add.
So, fully agree with that. And I think the other word that I want to speak about here is trust. Insurance at the end of the day is a very trust-driven, product. One of the reasons a lot of people don't take insurance because, kya hoga, claim milega, nahi milega, all of that kind of question. If Bima Sugam can become that trusted platform, which everybody can look up to and they know, and things like, KYC is one piece, but linking it with like the DigiLocker that we are talking about, I think we should not devalue that. That's a huge piece that can come in very handy. Let's say you have taken a life insurance and that is linked to the municipality record where death certificates come automatically, for example. So the moment this happens, your nominee gets paid. Things like that. I think if we are able to build that trust factor through this platform and the digital part that we are talking about, that would be really a game changer and a leapfrog for the industry overall.
Mr. Bharendra, if you would like to add something.
See, the trust factor is there, and as Banerjee said that claim milega ki nahi milega. We don't see at a large data point. Let's look at IRD annual report 2024. More than 2.25 health insurance claims are settled. 89,000 crores is paid in health insurance claims. The challenge over here is that the industry is not publicizing this claims paid data adequately. That's a big challenge. We have had this conversation with the GI Council and LI Council in the past and also at IRDA that we have to tell what we are doing. General insurance industry collected 3.11 lakh crores premium 31st March 2025 and close to 1.6 lakh crores were settled in claims, motor, health, property, everything put together. So that's huge. Who is going to talk about this? We have to talk about it. And unfortunately, insurance as a product is that the moment of truth of insurance is claim, right? Insurance has to respond during death, disease, disaster. The 3 Ds of thing. Maybe 10 crore odd people are covered under health insurance. A very small percentage of them make claim. And a very small percentage of that don't get claims. Maybe missold policy, wrong claim, fraudulent claim, or some insured exhausted, so on and so forth. But that small percentile is creating a huge trust question mark. But this huge population which has made claim, we're not talking about that. So this narrative has to change. And that Bima Sugam can help by making claim easy, the process of claim easy. But this data metric, collectively we as all constituents of the industry have to publicize this and make the policyholder or the prospective policyholder aware about it.
I'll open the floor to questions. If anybody has any questions, they can raise their hand. Yes.
Hi, my name is Naveen. The vision of the Bima Sugam says insurance for all by 2047. And looking at the distributor level, I mean the agents at 2.5 million, do we think that this electronic mode will definitely help us achieve this target by 2047? And what is the role of awareness of policyholders that you see when it comes to even being aware of Bima Sugam as an alternative option? Because there are many things in the securities market like ASBA and everything which still require awareness. So how will Bima Sugam be made aware to policyholders? Thank you.
You can take that question.
So see, when we talk about awareness, of course, lots of awareness campaigns would continue to happen. You would have seen one at industry level campaign which has been rolled out recently. How Bima Sugam would also create a differentiator is that today, suppose if you buy insurance, as I was mentioning, only when it is mandatory by law, financial obligation, or you rarely feel the need for any product. However, if at all you buy, here you are learned, you would broadly see what is covered. Bima Sugam would also have a facility where in a vernacular language it would be explained what is covered, what is not covered, exclusions, premium computation. So when someone who is buying a policy through Bima Sugam in hinterlands, rural pockets, or assisted by an intermediary and by insurance, so that person is using locker facility and maintaining policy, making a claim, will going to get habitual. So more than awareness creation through such media hypes or television commercials, hoardings, I think awareness gets created by elevating the understanding level. So when you will understand your policy document, I buy policy from insurance background, but I think rarely could read, maybe I do not have time, you do not have time. Nobody sitting in this room would have read the full policy document. So Bima Sugam will make it easy. And once I start understanding, I'm saying I means as a customer, what I am covered for, so my interest will start getting developed. So as I was mentioning that Bima Sugam will create a need to develop products which are actually required. Specific requirements need to be met. Not that because health insurance, you buy full health insurance. Buy only that element of entire health indemnity policy which you specifically need for yourself. And if you go through in detail as a customer, it becomes very easy. Interest gets developed. And then maybe there are products like spectacle insurance. I don't know how many of you are aware. Pet insurance, for example, which are not much advertised products. But then you never know that after motor and health, which are contributing about 70% of total GDP that gets generated in our country, pet insurance, because we have many pet parents, every second person we see pet parents. So that kind of a change also we are seeing. So I think Bima Sugam would have everything in terms of enhancing not only learning, but more than that understanding, which will be a trigger for having all of them in insurance ambit. Because in matured markets, every customer would have about 4 to 5 insurance products, unlike our country where it would be 1 or 2. So capturing maximum wallet share of the customer is very revenue-centric approach. But when I make this statement in a different way, that every individual has minimum requirement of 5 different covers, insurance covers, to claim that he or she is socially secure, is what Bima Sugam will going to facilitate, enhancing understanding, enabling through that every individual to buy insurance. And then only we can say that insurance inclusion is comprehensively achieved, whether it happens by 2047 or it can happen much before that also. Thanks.
Just to add on the awareness piece, there are 2 aspects to insurance awareness, as Mr. Mathur rightly said about understanding your policy document or the policy that you bought into. Second, making insurance as a preferred risk transfer tool or product and making that a people's movement. So there some work should be done. We have seen a lot of insurance awareness coming because of the Pradhan Mantri Jan Dhan Yojana and the PM Suraksha Bima Yojana and Jeevan Jyoti Yojana attached to it. Additionally, what the industry can do and the government can do if we can designate. That's one of our proposals which we gave to Honorable Finance Minister when we met her recently. April 19th is IRDA Foundation Day. Can we make April 19th National Insurance Awareness and Policyholder Day? Celebrate that day, celebrate that week of April 19th as the National Insurance Policyholder Week. Make outreach to high school children. Talk to them about risk management, risk mitigation, risk transfer, and career opportunities also in the insurance sector, which our association had started in the past in a small way. We reached out to high school children, talked to them, present to them about insurance. So there are two aspects to it. A, understanding, yes, insurance is a product which will transfer your risk and will help you mitigate your financial losses whenever it happens. And secondly, understanding a policy document, as you were saying.
I think we'll take one last question. Yeah.
Good evening, everyone. So I'm Prachiti Satya. I'm from Sydenham Institute of Management, and I'm from MSc Finance batch. And I wanted to ask about, when we were discussing about UPI, we said that it's easily adoptable and it's easily understanding. And sir mentioned that it's a complex product when it comes to insurance. So how do you think consumer will be comfortable understanding and adapting the Bima Sugam, like this platform?
Who wants to take this?
See, I think what we discussed is that we have to make the products simpler, and that endeavor continues to happen any which ways in the industry. From a policyholder perspective, there are two ways, again, right? The platform has to be simple enough so that I can easily check, compare, find, and buy. That's one aspect. And the second is whether the product is simple enough or not. And that product personalization and all that Amit and Mr. Mathur spoke about is about simplification of that product. How do I make it very personalized? How do I make all of that happen? And if the insurance companies are using this as a digital portal, the policyholders are coming there, then automatically this becomes a little bit more personalized kind of products that they will start to endeavor and start to make that, right? So that's what we are talking about. And obviously from Bima Sugam side, the platform has to be made very simple and easy.
I'm tempted to give one example on this. And gaming, in this country, there was no training, no content, but would you believe the way the industry is developing? It's a 80,000 crore industry now, silently. Do you think this is happening only because of Mumbai, Delhi? No. The maximum amount of revenue is coming from your Cat 3, Cat 4 city. So India is transforming, silently transforming. So like I'm saying, I'm incorrigibly optimistic about Bima Sugam getting adopted by those hinterland, probably faster than all of us think. And to the point that you mentioned, why do you feel 2047? It can happen much earlier than that. There's nothing holy about 2047. It's all about reaching that tipping point, and I'm sure Bima Sugam is going to get that.
2047 is the context of the journey of Viksit Bharat. So the government has given a goal that let us make insurance mandatory, or not mandatory, let us get everybody under the ambit of insurance by 2047. We can definitely do earlier to that also. And let's look forward to the Bima Sugam.
Yes, I think we'll draw, I think we are out of time, so I'm really sorry. So we'll draw the panel discussion to a close. I think what we have learned is Bima Sugam is indeed a UPI moment for the insurance industry, if done right, to borrow Mr. Banerjee's words. So I'd like to thank every one of you to be so candid with your answers. Thanks a lot.
Just like an insurance policy with terms and conditions, if
Yes.
done right.
Yes, absolutely. Thank you so much, everyone. Thanks a lot.
Thank you very much. The gentleman who had the question there, you
If
can take
guys
it
could
offline,
stay on
please.
for the mementos.
This sounds like a really promising...
Mr. Rafi, you can just stay, we'll present you the mementos.
Sorry, yeah, please. The mementos, please. It's a very promising concept, and we'll get a sense of it once it goes live, like you were saying, early 2026. And of course, it will be an evolving concept. Once it's unveiled, once it's live, we'll get to know what more is needed, and like many novel ideas, it will evolve with time. Thank you very much, ladies and gentlemen. Thank you very much. This is all for today in this particular hall, but we will be back tomorrow again. The day, however, is not over. We currently have a conversation on with the chairperson of BFRDA at the Chintaman Deshmukh Hall. So do please go over there. And after that, after a very packed day of conversations and insights, there will be some moments to laugh because we have a stand-up comic. We'll end the day on that. We have a very cerebral stand-up comic, Mr. Rahul Subramanian, who will be there again at the Chintaman Deshmukh Hall. So do stay back for that as well. Thank you very much.